wanted the S&C to be a Shout out to everybody here on the live. Thank you for jumping on in. Appreciate each and every one of you for being here. Let's put the lemon into the water. Let's get ready for Jerome. He's about to slam us. Let's see what's happening. We're going to have Bitcoin up in the charts. We're going to look at Bookmap. We're going to have it going. Let's get a big sip of that lemon water. Let's keep it going in the house. I got the white shirt for Jerome. Should have worn the solid tie, but it is what it is. Shout out to each and every one of you. God bless you all. And we're going to get it loading here. We're going to get it up and running. See what happens here. 10 a.m. live. Looks like they're a little late on the live. They don't come on time. It's funny. But we're going to be watching it here live, waiting for the news to begin. It is 10:04. They're scheduled to set at 10 o'clock, so they are late for their live event. And only time will tell. We have it up on CoinDesk too as well. In that time, we can take a look at Bitcoin while we're waiting. Get the music on up and keep it kicking. Shout out to everybody here on the live. Thank you for jumping on in. Appreciate each and every one of you for being here. If you're new and you watched me yesterday and you're coming back in, welcome to the channel. Welcome, welcome, welcome. This is the place to be. May God bless each and every one of you for jumping on in. So, moving forward, what do I see happening for Bitcoin? Good day, Sam. Looking sharpy-doo. Thank you so much, man. Class was awesome yesterday. Thank you so much for saying that, and tell people how great you love the class. All right? So more people will join the class. Let them know the class was absolutely amazing. And look at behind me, a lot of money pouring into cryptocurrency, more than normal, just flying on in. We got Bitcoin, we got Litecoin, we got Filecoin, Ethereum. We got a lot of SHIB coming at us. Let's take a look at what's happening for Bitcoin as it hugs 22,000. So here, my idea for Bitcoin was this. We were looking at BTC. BTC was in this tight channel to the side. It was in basically a diamond, remember? If you remember the diamond, we were in a bit of a diamond. Bitcoin was in the diamond, but it did not reverse out of the diamond as it beautifully should have, which many times we've seen. We didn't get it. We didn't get the diamond move. We actually got a break to the downside. It was a symmetrical triangle. This could have been looked at as a symmetrical triangle, in my humble opinion. And symmetrical triangles break up or down 50% of the time. Mainly they break down. Chubby triangles usually are not the best. Here we go. And here we go.
At the outset, this hearing has a hard stop of 1 p.m. This is traditional for the Fed chair.
Hard stop, so it could be a 3-hour meeting. This could be all day, everybody.
I now recognize myself for 4 minutes to give an opening statement.
I always recognize
Thank
myself.
you, Jerome Powell, for your testimony today. This week, you stated that the Fed will, quote, stay the course until the job is done. And that is to restore price stability. This is positive. But you know as well as I do, you're facing a very strong headwind from the political left. Democrats are pressuring the Fed to stray from its narrow mandate.
Oh, this guy.
It's a page out of their same old progressive playbook. When they don't have the votes to achieve something here in Congress, they turn to regulators. And now, Chair Powell, they're looking at you and the Federal Reserve. President Biden's kowtowing to the far left is what got us into this inflationary mess. I urge you to reject the ideologues who put their social agenda ahead of economic prosperity. High prices continue to eat away at workers' wages and retirees' incomes. Since President Biden took office, we've experienced inflation at rates not seen since the late 70s and early 80s. Inflation rapidly accelerated after Democrats passed their so-called American Rescue Plan, which poured nearly $2 trillion of inflationary fuel into the economy. By June of last year, the Consumer Price Index showed inflation skyrocketed from below 2% to nearly 9%. And personal consumption expenditures, the Fed's preferred measure of consumer prices, ballooned to 7%. Instead of being rescued by Democrats, Americans were punished with pain at the grocery store and sticker shock at the pump. While inflation is now below its mid-2022 peak, it is persisting at rates well above the Fed's target. It remains broad-based and continues to hammer Americans' pocketbooks. In fact, a recent Gallup poll shows half of the respondents say they are worse off financially than a year ago. It's clear that there's still a long way to go in the effort to bring down costs. I look forward to hearing you reaffirm your commitment to that work today. Republicans also want to hear from you regarding some concerning developments at the Federal Reserve on the regulatory front. Recently, the Federal Reserve's Vice Chair for Supervision announced a quote-unquote holistic review of bank capital in the Fed's regulatory regime. However, it seems that only a small group within the Fed knows what this means, what it entails, how much review is being vetted by the full board, and the type of quantitative analysis the Fed is performing. The Fed shouldn't operate in the shadows, especially when the regulation in question can have broad and significant economic effects. It's also unclear the motivation for the Fed's holistic review, particularly when so many board members have stated that the banking system is very well capitalized, and any review of capital standards should be targeted. It also appears the Federal Reserve Board is laying the groundwork for climate policy to be implemented through the Fed regulation with an opening salvo to quote-unquote scenario analysis. Addressing an issue like climate change is important, but a policy that should originate here in Congress by the elected representatives of the people, not the central bank. As you said, the Fed needs to...
Much, Mr. Chairman. Good morning, Chair Powell.
What?
Since your last visit, our country, under the leadership of President Biden, has made major progress to improve economic conditions,
What was that all
including adding a record 12 million jobs, reducing unemployment to its lowest rate in 54 years, while also reducing the deficit.
Unemployment in 55 years. I never seen more people not working in my life. Like, everyone is lazy out here. People were working more 5 years ago. I don't believe that.
Unfortunately,
just not from what I see.
Many families are still struggling to afford basic necessities because of inflation.
Sounds like a lot.
What's more, interest rate hikes,
I could be wrong,
are making borrowing, especially for mortgages, outrageously expensive. Since I raised this concern for you in a November letter, the rate hikes continue to have an outsized impact on housing costs, which are, as you know, a primary driver of core inflation. But, Mr. Chair, I think that you will agree that Congress also has a role. That's why I'm somewhat disappointed that after 2 months, Republicans have taken no serious action to address inflation. By this time last Congress, House Democrats had passed the American Rescue Plan.
That was printing more money. Wait. She just said that they printed even more money in that rescue plan. That rescue plan was more money printing. I'm not even a Republican or a Democrat. This is insane to me. She just said that we did something. You printed more money. That's all you did. Like, this is crazy to me.
From the ongoing pandemic, which included our committee's efforts to provide $70 billion for homeowners, renters, businesses, and first responders are looking for our committee. Democrats have put forth additional bills like the
all that money printing
to bring down costs for Americans, especially housing costs. Even more concerning.
Look at that head and shoulder breaking to the upside as shown right before it started. Banging, about to hit the target. Look, this is about to hit the target.
Including spiking.
I just drew this 30-second chart. This is how you do it. If this is how it's going to start.
I'm talking about the threats by Republican leadership to force a default on our nation's debt.
That's how you get down.
If we don't agree to their demands to cut Social Security, Medicare, or other critical programs. You've urged Congress to take immediate action to raise the debt ceiling.
It's going to the target.
But rather than focusing on
target
the
hit.
very real
Bah! First one.
The first bill that committee Republicans brought to the floor instead suggested that Social Security and Medicare are socialist threats.
It's crazy how that works, huh?
Since then, we have considered legislation related to deregulating securities and banking laws and countering threats from China, but Republicans have completely ignored the biggest economic threat to businesses, consumers, and our economy defaulting on our debt. Last month, I wrote a letter to Chair McHenry urging him to take this matter seriously and hold a hearing, but I'm still waiting for a response. I hope Republicans will listen today to the
Everything's bipartisan, even though she's supposed to be talking to the Jerome
real
Powell.
consequences that even the mere threat of a default would have for everyone in this country. And finally, I'm so pleased that we're finally making progress on diversity and inclusion for key positions at the Fed.
Hit the target right there, inverted.
Last year's historic confirmation of Dr. Lisa Cook to serve as the very first black woman on the Federal Reserve Board, with the board's vice chair and Kansas City Fed president positions vacant. I think President Biden...
I'm all about inclusion, but now we watched yesterday and today, and both of them were like, you better put, the Spanish people were like, you better put a Spanish person in. She's saying, you better put this woman in, and they're both saying, like, if you don't put this person in, then you guys are uninclusive. But what if, like, that, hopefully the person is. What if the person just doesn't, like, you have two people and you look at the resumes and one person has a higher, ability to handle the job, right? This is what the problem is. People are saying that everyone's going to get a job based on just who they are, not on what they know, right?
And Kansas City
at the same time, I'm with her. Like, there should be some,
like,
it shouldn't be all one white dudes. Like, there should be some type of mix there. I think a mix would be good for all of us because it would put a different voice in there and maybe would actually shake things up. The whole thing's a mess anyway. We all know what I think about it.
Candidates for these positions. With that, I yield back the balance of my time.
The ranking member yields back the balance of my time, asking unanimous consent to submit for the record my letter to Secretary of the Treasury Janet Yellen from February 28th, asking for an update on the subcommittee.
Businesses around the country. It is paramount that the Federal Reserve remain vigilant on reducing inflation, anchoring inflation expectations, and restoring price stability at the Fed's 2% target. I also look forward to discussing the Fed's regulatory and supervisory activities. As the Fed reviews the bank capital framework, it needs to consider the impact to the real economy and our global competitiveness when raising capital requirements and sidelining capital would work at cross purposes with monetary tightening, constraining the supply side when we need more, not less, investment to fix supply chains and reduce inflation. Tailored regulations are required of the Fed by law, and a one-size-fits-all approach would be the wrong path to take. Finally, I urge the Fed, in your words, to stick to its knitting and not attempt to be a climate regulator. I yield back.
Gentleman's time has expired. We'll now recognize the ranking member of the Financial Institutions Subcommittee, Mr. Foster, for 1 minute.
Thank you, and thank you, Chair Powell, for being here today. Today is the 15th anniversary of when I was first elected to Congress and placed on the Financial Services Committee, just as the economy was about to collapse. And so that was my trial by fire, the emergency response to rescue the economy and the legislative response, the Dodd-Frank Act,
Next target,
that successfully
22,000,
stabilized our financial system. So 15 years later, as I take my place as the ranking member on the Committee of Oversight over U.S. banking and monetary policy, I recall the solemn oath that I swore to myself back then to make sure that this kind of calamity never happens again. The monetary policy report that we're receiving today is largely a narrative of a return to normal. Lead times to manufacturers are back to pre-COVID levels. The job market retains supernatural strength, and inflation is responding more or less as predicted to the usual measures. And by far, the largest threat on the horizon is a repeat of the 2011 default crisis. Congress has the power to avoid that, and we owe it to the American people to do so. And I yield back.
Today, we welcome the testimony of Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Chair Powell was reappointed and sworn in for a second four-year term as chair on May 23, 2022. Chair Powell also serves as chairman of the Federal Open Markets Committee and the system's principal monetary policymaking, which is the system's principal monetary policymaking body. Chair Powell, we thank
people to do so, and I yield back.
Today, we welcome the testimony of. We will recognize you for 5 minutes to give an oral presentation or testimony. Without objection, your written statement will be made part of the record. Chairman Powell, you're recognized.
Chairman McHenry, Ranking Member Waters, and other members of the committee, good morning. And I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we had seen in the data just a month ago. Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with the revisions to the previous
Said the same
quarter,
thing yesterday.
suggest that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above our longer-run objective of 2%. The 12-month change in total PCE prices has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said, there is little sign of disinflation thus far in the category of core services excluding housing, which accounts for more than half of core consumer expenditures. To restore price stability, we will need to see lower inflation in this sector, and there will very likely be some softening in labor market conditions. Although nominal wage gains have slowed somewhat,
You got resistance, 22,125 now.
With 2% inflation and current trends in productivity.
Beginning to fall.
Strong
Book map
wage
showing
growth is
liquidity
good for
below.
workers, but only if it's not eroded by inflation. Turning to growth, the U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remain very strong in January, while the supply of labor has continued to lag. As of the end of December, there were 1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historic lows. Turning to monetary policy. With inflation well above our longer-run goal of 2% and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past two meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity and inflation. Although inflation's been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If,
Not good.
and I stress that no decision has been made on
0.5.
this, but if the totality of the data were to indicate that faster tightening is warranted,
He's opening for
we'd be
0.5.
prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals.
Bet you will.
Thank you. I look forward to your questions.
Thank you, Chairman Powell. I'll now recognize myself for 5 minutes for the purposes of questioning.
Phone waves broke back
Chairman
up.
Powell, there's been a lot of discussion over the last 24 hours about the effect of rate increases on the economy. A lot of debate about what you said yesterday in the Senate. But no one asked you this directly. We have a March meeting coming up, Open Markets Committee meeting coming up in 2 weeks. How do you think about the March meeting? What's your approach to that? What are we likely to see?
Thank you. So I won't repeat what I just said in my testimony, but if I turn to the March meeting, I guess I would say that we have some potentially important data coming up, data to be analyzed. One of them came out at exactly 10 o'clock. That would be the JOLTS report, which, of course, I haven't seen, being sitting here at 10 o'clock. But we're also getting a jobs report on Friday and a CPI and PPI inflation report next week. So those will be important, and we'll scrutinize them. When we say that we're going to be looking at the totality of the data, which is what I said, that does include these reports yet to come. They're going to be important in our assessment of the higher readings that we have very recently received and of the overall direction of the economy and of our progress in bringing inflation down. And we'll be carefully analyzing them. Again, we have not made any decision about the March meeting. We're not going to do that until we see the additional data. The larger point, though, is that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook.
But you've also said higher, longer. Is that still the case?
Yes. So, as I said in my testimony, we look at the data since January and also the revisions to the November and December inflation data, and they suggest that the ultimate level of interest rates is likely to be higher than we'd expected.
And what are those economic factors?
So going back to January, as I mentioned, the softer inflation readings of November and December were revised up. We got a very strong inflation report for January. We got an extraordinarily strong employment report, very strong consumer spending, strong manufacturing data right across the board. And as I pointed out, some of that may have been affected by the very warm January weather, but nonetheless, all of it pointed in the same direction.
Okay, let's move to regulation. Chair Powell, in January, the Federal Reserve put out a policy statement noting that digital asset custody is a permissible activity if done in a safe and sound manner. However, if a bank can demonstrate to the Fed that it can conduct that activity in safe and sound manner, the capital impact of the SEC's staff accounting bulletin effectively precludes banks from offering digital asset custody service at any scale. Are you aware of this staff accounting bulletin by the Securities Exchange Commission and its impact on custodial services?
I am aware of it. Of course, it's an SEC accounting bulletin. This is SAB 121, I think. And
that's right.
Certainly aware of it, and we do follow general accepted accounting principles in our
yes.
capital regulation.
Okay. Well, without objection, I'll submit to submit for the record my letter to the bank regulators about this. So while the Fed says it can be done in a safe and sound manner, the Securities Exchange Commission has regulated it so that it cannot be done. Next question is certainly about bank capital standards. You got questions about this yesterday. Chair Barr has announced a holistic review of capital requirements. As I said in my opening statement, there are a lot of questions about this process. and previous statements by members of the Fed governors about the adequacy of current capital standards. And so while the Vice Chair for Supervision has announced that the Fed will engage in a holistic review of capital regulation, is that Fed staff? Is that done at the at the governor's, the board level? What is the process? There are a lot of questions that people have about his statements. And so we want to understand why it's necessary for the Fed to conduct a holistic review and what that process is. So, my general question is, do you still agree with your previous statements about the adequacy on a generalized basis of our financial system? Or are we to read into this that we're not adequately capitalized and there's a high level of risk in the system that we're unaware of at this point?
Thank you. So the why really just is that as a new Vice Chair for Supervision, Vice Chair Barr has launched into, he's taking a fresh look at everything, including capital. That actually is typical of the last two people to have this job. So that makes a lot of sense. In terms of the process, it's certainly conducted under Vice Chair Barr's leadership with input from the staff and discussions with governors on that committee, and I'm kept broadly apprised about what's going on. But the bottom line is nothing has been proposed to the board. Nothing has been formalized at this point. It's a lot of work that's going on. I think discussions are going on, meetings with industry and that kind of thing. When we get to the place where that's appropriate,
discussions are going on.
The board will be carefully briefed.
He doesn't even know what he's
Ultimately,
talking
we'll
about.
vote on a proposal, and that proposal will go out for comment, and we'll solicit comment from any and all commenters, and we'll look very carefully at that. So it'll be a wide open
bullpen it.
Process in the sunshine.
Thank you. I yield back. Now recognize the gentlewoman
sunshine.
from California, the ranking member,
Ms.
Waters.
Thank you very much. Chair Powell, I agree with what you said on February 1st, that Congress must raise the debt limit because of what you described as the highly risky consequences of failing to do so. You are perhaps the most important expert on the debt limit, which is why I find it very concerning that your recommendation to raise the debt limit in a timely manner is being ignored by my colleagues on the other side of the aisle. I'm also concerned that the consequences of this brinksmanship are imminent. Fitch Ratings said this week they may seriously look at downgrading the U.S. debt based on the escalating brinksmanship they are observing, even if Congress ultimately addresses the debt limit at the last minute. This is history repeating itself. Standard & Poor's downgraded our debt back in 2011 when Republicans last controlled the House and threatened default. The Bipartisan Policy Center later found that the 2011 debt limit debate cost us $18.9 billion in higher borrowing costs, even though we never defaulted. To put that into perspective, that could have been leveraged to provide up to $200 billion in loans to small businesses through the state Small Business Credit Initiative, or to provide hundreds of thousands of people down payment assistance to buy their first home. So I want to emphasize that House Republicans, including most of the Republicans on this committee, had no qualms about paying our debts when Trump was in office. 3 times they addressed the debt ceiling in a timely manner without holding our country hostage. But Republicans are ready to tear down the hard work of Americans everywhere to weather the pandemic and build back a strong recovery. Chair Powell, can you describe for us the risk you see if Congress continues to delay action on the debt limit, both for our economy and for individuals and families?
Let me start briefly by saying that we have no role and seek no role in what is really at the heart of fiscal policy, except I will limit myself to the 2 things that other Fed chairs have said about this. One is just that Congress raising the debt ceiling is really the only alternative. There are no rabbits in hats to be pulled out on this. 2 really is just that no one should assume that the Fed can protect the economy from the non-payment of the government's bills, let alone a debt default or something of that nature, which we don't think will happen here, but no one should be thinking that we have the tools to protect the economy from all the potential effects.
They owe you the money.
Thank you very much. I don't want to miss what
This
you
is
said.
crazy.
I somewhat quoted you when you said that Congress must raise the debt limit because of what you described as a highly risky,
She's 81 years old.
consequence of failing to do so. Is that your language?
Well, must in the sense that it's really the only way for the debt limit to be raised is Congress must act. Again, these are fiscal discussions, and we don't want to be a part of them, and really they're between elected officials.
But you are an expert on the subject.
Well, I spent a lot of time on this, as you'll recall.
As an expert
prior
on
years.
this subject, you are concerned about the high risky consequence of failing to do so. Is that correct? Did I correctly quote you?
That's correct.
Thank you. And so, again, let me just go a little bit further. The chair mentioned that he had either written a letter or maybe even had some conversation from Janet Yellen about the time limits that she had attempted to describe. Is it your understanding that she said she could maneuver and kind of manipulate things so that she paid the bills that were coming due, but this could only last until about June? Is that your understanding?
Honestly, I would really have to not try to interpret the Secretary's
You know,
words.
he's not going to play
That's
with
really
this
up
at
to her
all.
to do.
Can she keep us afloat until about June?
I don't, honestly. That's not for me to say. These are really questions for the Secretary. I'm sorry.
Have you had any conversation with her about the statement that she made about being able to manipulate the debt and pay bills that were coming
It's not
due
even funny.
out of
Like, I'm
another
not even.
account, et cetera?
It's
Did
so
you have that
horrible. It's
conversation
funny.
with
It's
her?
horrible.
The conversations that you and I have privately don't go anywhere. I don't talk about them with anybody. And the conversations I have with Secretary Yellen, I don't.
Okay, and I don't want to get you
Gentlelady's
in a-
time is expired. The gentlelady's time is expired.
Did I have equal time with you?
You sure did. He went over time.
If I did,
God.
thank you. I yield back.
I now recognize the Vice Chair of the full committee, Mr. Hill of Arkansas.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us. You're welcome anytime. Don't wait till we ask. If you want to volunteer and come, we love having your views on many topics. Thanks for talking about your commitment to price stability. You know,
At least she fights for her thing. You know what I mean? I don't agree with everybody, but it is what it is.
we've had this discussion last June between us of, I do think that's the primary mission of the Fed, and I think it should be the only priority of the Fed is price stability, because it's the legislative branch and the executive branch that really are responsible for, quote, full employment and having that policy environment and making sure that that's right. So your commitment to price stability is welcome by this committee. Yesterday in the Senate, you suggested that you supported a regulatory framework, a broadly regulatory framework for digital assets. Is that right?
Yes.
And is it your view that if we had a regulatory framework here in the United States for digital assets, that there'd be more transparency and rules of the road for both consumers, investors, and developers?
Absolutely.
And would it, if we had those rules of the road for business seeking to use and develop blockchain as a potential new technology in their business and tokenized payments, that, again, that would be beneficial to business to know how to go about that?
Yes, and to assure that it's all done in a safe and sound manner when we're talking about banks.
Right. And then, my next point would be exactly that, to help banks, investment brokers, custodians understand how they could even participate in that market in a safe and sound manner. You agree that a regulatory framework would help on that?
Yes.
And then finally, we've grown up in our country, and it's unique in the world, that we have a dual banking system. And due to a quirk here in Congress over 100 years ago, we have insurance is regulated exclusively by the states. So would you believe that that regulatory framework would also have to preserve some sort of role subject to safety and soundness, for states to play some role in that regulatory framework?
This is crypto here. They're talking crypto, everybody. This is big.
Let me just say, I think that it certainly works in banking and insurance. I have no problem with those.
Right. But you think it could, you consider it possible that it could also work in digital assets?
Certainly possible.
Yeah. Thank you. Turning to a topic that's been a subject here for nearly 4 years, central bank digital currencies. Article 1 of the Constitution reserves coins and coin issuance, money issuance to the Congress, and we've in turn delegated that to the U.S. Treasury, which has, since 1912, engaged the Federal Reserve as their fiscal agent. You've testified here many times before that to issue a central bank digital currency, that would have to be authorized by statute by Congress. Is that still your testimony?
So that is absolutely the case as it relates to a retail CBDC. There are potential forms of a wholesale CBDC that we need to look at. It's less clear. But we've always been talking about retail CBDC, and that's something we would certainly need congressional approval.
Wholesale, like
and
banks,
what would be a
banks
parameter on
end.
something that's not a retail CBDC where you think that could be issued in some form or fashion without Congress's direct statutory authorization?
It would be, for example, it would just be something between banks, so it would look an awful lot like a bank reserve.
God bless you.
You might ask, well, why would we
God
need it?
bless
And
you.
That's a really good
Thank
question,
you so much.
too.
Yeah.
But just something that's literally within a wholesale market.
But that speaks that you might have a blockchain between banks and the Fed using a central bank digital
Thank you very much for the
currency
$50
token
super chat.
to settle
God bless you.
transactions institutionally inside the. So that leads me to Fed Now, which is supposed to be up and running, I think, this summer, somewhat behind the scene there. I would like to ask you to formally have this full committee briefed on that by the Federal Reserve. I know the chair of the Kansas City Bank was involved. She's now left. And I think the committee has a lot of questions about Fed Now, how its interoperability will work, how it's going to roll out, and also just a question that we've been asked that why the Fed wire system isn't up 24 hours a day, 7 days a week now to benefit consumers that are using Venmo. Do you have a thought on that?
I'm not sure why we're not 24/7 on that, and we, of course, be delighted to come up and brief the committee on Fed Now.
That'd be good. We'll take you up on that and the right person from the Fed. And Mr. Chairman, I yield back.
Gentleman yields back. We'll now recognize the the ranking member of the Capital Markets Subcommittee, Mr. Sherman of California, for 5 minutes.
Thank you. Mr. Chairman, I want to thank you for bringing to our committee's attention several years ago the importance of tough legacy LIBOR, some $16 trillion of instruments where the creditor wouldn't know how much the debtor was supposed to pay. This committee, we passed legislation over a year before the LIBOR hit the fan. You issued regulations 7 months before the absolute deadline. I hope we do this in other areas, and it's my understanding that with those final regulations, we're done, and we've solved the LIBOR issue. Is that correct?
That's my understanding as well.
Good. People talk about inflation, and they somehow say that it's a matter of the personalities and politics in the United States. Others argue that the entire world is hit by inflation because Ukraine and COVID. I think we've got the answer to this question in that inflation is considerably higher in the Eurozone than it is in the United States today. And it's very hard to say that Joe Biden is responsible for inflation in Germany. I commend the ranking member for bringing up the debt limit and the harm that's already done to our economy. If we solve the problem tomorrow, we had less investment than we would have had yesterday.
People aren't thinking straight.
And I would say that I commend the president. He's going to issue a budget plan tomorrow. And perhaps in their time, one of our Republican colleagues can tell us when the Republican budget plan will be released. We are all eagerly awaiting it. Okay. Housing is a huge part of inflation, and we've left it to local government, but the permitting process there guarantees scarcity, which guarantees high housing costs. Mr. Chair, we've talked back in 2001 and several times even before that about wire fraud. And having just bought a home, I saw the process up front. Everybody's very nervous about one thing, and that is, will the buyer of the house be tricked into wiring their down payment to the wrong account? Or will the seller, the buyer be tricked or the escrow agent be tricked into sending the money to someone other than the seller of the property? We talked about this back in 2001, where I urged you with your FedNow system, which I'm glad is on track to move forward, to have what the Brits have. When you send the wire, you identify not only the number of the account you're sending it to, but also the name of the person or entity that's supposed to receive that. At that time, back in 2001, you said that payee matching is not the best way to do it. There are other ways to do it, and that you'd be happy to get back to me as to how you're going to make sure that an email from a Nigerian prince does not get the wired funds, particularly in a housing transaction, wired to an account number that turns out to be in Lagos. What progress do you have? When can home buyers have a system where they're sending it to?
Did he really just say he asked him a question in 2001? Or did he mean to say 2021?
I hope we did come back in a timely way to you on that. But it's a problem you've brought to our attention, you're right, over many years. And we continue to focus on that.
Well, the bureaucrats who are working on this don't want to do what the Brits did. They've proven it can be done. You said you were going to accomplish the same goal.
He just said he was doing it when he didn't do it. That was he should have just said we haven't done it yet.
Nor are you aware of any
he
solution.
Got called out.
I would hope that you would go back and say we don't want to add this anxiety to every real estate transaction. What are you go back to the drawing boards.
I get it.
Follow what the Brits have done. And
I'm not going to say it shouldn't be more
matching.
Scrutiny.
Finally, as to crypto.
With a K. You saw that with a K.
Cryptocurrency.
Oh, this guy.
Says what it means.
This guy.
Hidden money. That's what it means.
Oh, my gosh. Here he
goes.
Here he goes.
If we
it's not hidden money. You can see the blockchain.
Know your customer and anti-money laundering statutes to it, it won't be crypto anymore. What crypto wants is to have part of its ecosystem above the waterline, visible and subject to know your customer, and then have the rest of the iceberg below the waterline.
No.
Gentleman's time's expired.
That's not true.
Now,
that guy's out of his mind. I don't think he has any idea what he's talking about. Like he is. That's the problem right here. We have
Chairman
people,
McHenry, thank you very much. Chairman Powell, thank you for joining us.
God bless
today.
him, man.
Appreciate not only your professionalism but your direction at us.
What was that?
Chairman
he never even
Powell,
asked the guy
I know
a question.
that the Fed considers divergences, and you talked about it as you spoke in your opening statement about consumer price index, personal consumer expenditures, inflation, GDP, and all these things are talked about in your report, monetary report, March 3, 2023. Thank you. A couple days ago, I had an opportunity to see that an economist, Arthur Laffer, produced a report that spoke about literally this country doubling GDP. Now, I know we're putting CPI, PCE, inflation, all these things into a mix. But he said that if we made changes in health care to efficiencies, we could double the current GDP rate. My question to you that I hope you can answer is, what do you think about that? Is that something that is in this document that I have missed? And it's seemingly to a person who follows this, as Art Laffer does for 50 years, what do you think is an important way to look at efficiencies in healthcare? Thank you.
So no, that's not in our monetary policy report. I'll just say one thing, and that is we do spend something like 17 or 18 in that range percent of GDP delivering health care. Other similarly wealthy countries spend 10%. So it's the delivery system. It's not that the benefits are incredibly rich or anything like that. It's just that the delivery system is very expensive. That's $1 trillion a year that we spend and get nothing for it. This is fiscal policy, but I'm responding to your. So I would think that he may have meant that if we had a delivery system that saved that $1 trillion that doesn't really get us anything, then that would be great for the economy, which I would agree with.
So you've spoken of supply chain disruptions because it in fact is an inhibitor or an accelerator as we gain that advantage. You just talked about some seemingly which would offer some validation to Mr. Laffer as he spoke about the huge importance of this. Is that something you should start paying attention to where policy people, not only at the Fed, but your Fed banks around the country would start looking at and start putting pressure on us to gain those efficiencies as a result of a global view?
So on supply chains generally, they have suddenly been tremendously important in inflation, as you know, for the last couple of years, and for the first time really have been something that we've had to study carefully. In terms of healthcare delivery, that is strictly a question for you and for the parts of the government that are charged with it. The Fed does not have a role to play and does not seek a role.
It does not see a role. And yet, as I look at this, you've got a role in projecting confidence. You've got a role in education. You've got a role in who's in the workplace. You've got a role. My interest rates, and yet my point is it's such a staggering number that impacts us. Just love to have you go back. Perhaps we from this committee need to give you some direction on that. But I think your testimony today, it recognizes the staggering impact on that. I don't think it's political. The answer may be political, but I think the actual numbers are not political. It's an inefficiency that is happening across the country, not a regional matter. And so I wanted to get your take on that, and I appreciate you being here as always. Thank you for your confidence and your hard work that you give this country. Mr. Chairman, I yield back my time.
Gentleman yields back. We'll now recognize the ranking member of the Agriculture Committee, Mr. Scott of Georgia, for 5 minutes.
Thank you very much, Chairman, and welcome back, Chairman Powell. Now, Chairman Powell, listen to me very carefully here.
Oh, no.
Because I think we're on the verge of making a terrible mistake. Back in 2008, if you recall,
he has 5 minutes.
Barney Frank then and Miss Waters asked me to take a look and kind of work with you and the Fed. You were a board member in 2008. And we came to the conclusion that we needed a more equitable playing field between our large banks, like Goldman Sachs, Citigroup, and our regional and smaller banks, like Truist and our community banks. And we changed that. But now I hear that the Fed and the FDIC plan to drop a new rule which seeks to apply the long-term and higher capital requirements that were created, and you and I did this back in 2008, and you remember, that were created for the Goldman Sachs and for them.
No, I'm reading the
comments. And now we want to apply these rules to the regional banks. There's a big difference, and we've omitted this difference if you proceed in this manner. I think it's very misguided. It works And you and I worked on this. You recall this. You were a board member. And we saw that we needed to have a better playing field to protect. And if you all go along with this, it could put many of our regional banks and small community banks out of business.
Yeah, they want to destroy those banks.
I want you to
reverse
this.
The wealth.
First of all, tell me, am I speaking the truth? Are you all planning to all of a sudden here put these smaller and regional banks under the same heavy or financial load as your large worldwide banks?
Totally.
Tell me.
No, we're not planning that. We believe strongly and always have in tailoring to address the different size and risk
nice
characteristics
ambiguous
of
word.
financial institutions.
Tailoring.
Certainly nothing like that for the regionals. They won't have anything like what the very large, most systemically important banks have in terms of overall regulation.
Yeah, because I remember clearly you and I were back, I think we were on this side then, talking about this in this same committee room. And you worked with us on that. I'm glad to hear that. Where is that coming from? I mean, it's a concern. It's just a rumor. Have there been any discussions about removing the playing field and the guardrails we have here?
Like, because
the differentiation.
I've been laundering a lot of money, and I don't want to have to pay
requirements between the regional banks, community banks, and your larger global banks. So there's nothing to that.
Well, I would say this: we're required by the law now, and we're
he could
doing
be
this.
louder.
Dodd-Frank actually required us.
Yes,
suggested that we should tailor. And then the S2155 then required it. And anything that we do will
Let's get the likes up, baby. 1,000 people on the live. Let's
appropriate tailoring.
All right. So that's off the board. We're not going to change and put the smaller and regional banks under the same financial obligation role as the large banks. We got that right from you, correct?
Yeah, that's right.
All right. Good. Now let me turn to China. I'm really worried
you got
about
5
China.
minutes, man. How can you still be on?
Right now, people may not know it.
Your time is up,
but
sir.
China
is
the world's
when they
largest
when they tell him
economy
his time's up.
In terms of purchasing power. Now, at our last meeting, I talked about this move where we didn't blow the balloon up. And this is an example of what I was pointing out.
Gentleman's time's expired.
Done.
We'll now recognize the chair of the Science Committee.
You knew he was going to get cut off. You knew it. You knew it.
Chairman. Chairman Powell, I'd like to follow up on the topic of capital standards.
You think he'd have a timer?
We've discussed many times together.
455.
As you know, commodity markets have seen significant volatility in the last few years. And during times of tremendous economic uncertainty, like we've seen, end users turn to the markets to hedge risk, particularly those in the agriculture and energy sectors. And I know that the Fed is early in the review process of potential changes in capital requirements. Can you, I'll ask anyway. Can you commit to ensuring that these changes will not increase the cost for banks providing those commodity derivatives to end users?
That's a really specific. Can I go look at that? I'm not actually sure that the work even addresses that. So,
fair point.
To come back to you on that.
And that particular response makes me feel better, because after all, those products are very important to my folks, and make a great deal of difference in how they're able to address their issues. So, as you discussed earlier, and as you consistently assured, the Fed's not a climate-making policymaker. You and I have talked about this issue, again, many times in the past.
Thank you.
However, I'm concerned that the Fed could be heading in that direction and could be laying the groundwork for climate-related stress tests that would reduce access to capital for entire sectors of the economy. This would also open up the Federal Reserve, potentially to political pressure, and force the Fed, in fact, to make policy decisions related to climate change. We've seen, for example, this administration turn to regulators to impose climate policy as an alternative to the legislative process. Chairman Powell, how careful are you in ensuring that the Fed does not place itself into the climate debate? And how can Congress ensure that the Fed's regulatory toolkit is not, shall we say, warped into creating climate policy outcomes?
So I think we do have a narrow but real role there, which is around bank supervision, making sure the banks understand and can manage their risks over time from climate. I think my colleagues and I all understand that it's a tightly circumscribed role that we're playing, and that we're not looking to move into an area where we're actually becoming a climate policymaker. I would completely agree with you, though, that over time that border needs to be very carefully guarded, and I will tell you that I will do that as long as I'm at the Board of Governors.
I very much appreciate that, because again, it's a very important issue to the 3rd District of Oklahoma. Traditional production agriculture, oil and gas, and the actions that the Fed takes have a significant impact back home. So it's vital that we resist the demands to do that sort of thing now or in the future. And I very much appreciate that response. And with that, I'll yield back the balance of my time, Mr. Chairman.
Gentleman yields back. The gentleman from Massachusetts, the ranking member of the Digital Asset Subcommittee, Mr. Lynch, is recognized for 5 minutes.
Here we go.
Thank you, Mr. Chairman. And thank you, Mr. Chairman, and for your willingness to come here and to update us.
With the
last
Boston
week, the
accent,
Treasury Department
Stevie Lynch
announced that leaders from Treasury would begin to meet regularly with leaders from the Fed
the green tie.
and the White House to discuss a possible CBDC, central bank digital currency, and other payment innovations. In the statement, it was mentioned, and I'll quote from it, it said that the Fed is encouraged to provide periodic public updates as it continues its research and its technical experimentation on central bank digital currencies. I was wondering, first of all, when you might be expecting to share some of these public updates. What's the timing on that?
So we did go out for comment in general on a CBDC
You had to wear a white
a year or
shirt
so
today.
ago, and I do expect
had to
we'll
wear a
go
white
out.
shirt.
I can't give you a date, but we'll certainly go out and
Preferably with the buttons.
engage. We engage with the public on an ongoing basis.
He got no buttons.
We're also doing research on policy and also on technology. That's what we're up to.
I'm aware of the Boston Fed has a partnership there, the Hamilton project over there with the folks from MIT Media Lab. They're doing a great job. But, it says here that the discussions would include technical experimentation. I was just wondering at what level are you talking about making decisions on architecture for a CBDC, a retail CBDC?
We're not at the stage of making any real decisions. What we're doing is experimenting in kind of early stage experimentation. How would this work? Does it work? What's the best technology? What's the most efficient? We're really at an early stage but we're making progress on sort of technological issues. The policy issues are equally important, though. We haven't decided that this is something that the financial system in the country want or need.
Right.
So that's going to be very important.
Right. Well, I think I speak for the chairman as well. Would love to have more dialogue with the Fed on that, and maybe bring in the folks from MIT as well, and just make sure that Congress and this committee is as up to date as others. Let me switch over to Fed Now. There are some champions of digital currency and stable coins in particular that continue to cite the need for faster payment systems. However, as was earlier mentioned, the Fed Now is a service that the Fed is working on to finalize that will allow for instant payments between bank accounts. And the Fed has a target release date for Fed Now between May and July, which is right around the corner. Do you see any reason why cryptocurrencies would provide faster payments than the Fed Now system? And would this offer, with the transparency of Fed Now, would it offer distinct advantages over some of these stable coins that are touting faster payments?
What Fed Now will do is it will enable all the banks, any bank in the United States, not just the big ones, to offer instantly available funds and real-time payments to their customers. That's what it will do. So that's a great thing. a CBDC, I think you're asking whether a CBDC would serve
This is
some
crazy,
of that.
right? Just hearing this.
CBDC is going to be years in the evaluation. And, I think we can get this into the hands of the public very quickly. And I think
Using the internet, babe, or something? Yeah, why? Stop my feed immediately. I don't know if you started playing a show or something. I don't know. Are you okay now? Nope.
Instantly
Here we go.
available funds and real-time payments to their customers. That's what it will do. So that's a great thing. A CBDC, I think you're asking whether a CBDC would serve some of that. But a CBDC is going to be years in the evaluation. And, I think we can get this into the hands of the public very quickly.
You heard this. Did
And
I
I think
get this?
State banks that were authorized to issue their own currency.
They had a glitch.
But when the greenback came out, all of those various currencies went to zero because, trillions right now. And I'm just thinking
they cut this out. They don't want us to hear about the greenback. Remember, that was the dollar I talked about.
Into a CDBC, wouldn't those alternatives go to zero if they did not have the transparency and the full faith and credit that
the Ascending Triangle looks to be getting tight and can pump to 22,447.
That don't have any intrinsic value, but nonetheless trade for a positive number. Those I've never understood the valuation of those. Stable coins are actually, many of them are really, they're drawing on the credibility of the dollar. They have dollar-based, they're dollar-denominated mainly, and they have dollar-based reserves, although we don't know what's in the reserves because there's no regulation.
Gentleman's time has expired. The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes. The chair of the National Security Subcommittee.
Thank you, Mr. Chairman. And thank you, Chairman Powell, for being here this morning. The reserve currency status of the dollar to the U.S. has enormous financial and national security benefits. In the wake of Russia's unprovoked invasion of Ukraine, the Fed took action to prevent the Kremlin from accessing more than $300 billion in reserves, roughly half of Russia's reserves. However, this led to an accelerated effort by countries like China to de-dollarize their official foreign exchange reserves. Just last week, there was an article in the Wall Street Journal titled, "Russia Turns to the Yuan," in an effort to ditch the dollar. Not only that, but China's President Xi Jinping pushed for the settlement of energy trades in the Chinese yuan at a summit with Arab leaders in December.
I saw that pattern, though. So
the question is, are you concerned about
Hello, I'm Mike Russell from Music
Russia and China to push to establish different reserves and conduct transactions in non-U.S. dollars?
It's going to ruin me.
So the U.S. dollar is the widely accepted and really the only serious candidate for the world's principal reserve currency. And that's because of our democratic institutions, our liquid markets, the rule of law, and all those kinds of things, and also the fact that the dollar has held its value over time. So other countries who are competing on other playing fields may want to establish different currencies, but really the dollar is the one that's going to be used more broadly in international commerce because we have those aspects and other countries don't.
Well, that's true to now, but my question is, are you concerned about the actions of these countries because if they see themselves being challenged or are concerned, for instance, if China would invade Taiwan, as Russia invaded Ukraine, there were some sanctions put on, and I don't disagree with the sanctions. The last time you were here, though, Mr. Chairman, I asked a question because it's an instructive moment for us from the standpoint that knowing that we put sanctions on Russia, all other different accounts, as well as the oligarchs from that country, are we thinking about doing the same thing to China when they invade Taiwan? And your answer at that point was no. We passed a bill out of this committee last week to ask the administration, basically, to start thinking about that in those terms. What kind of situations can you come up with? Are you talking to allies, begin to talk to them, to start putting together a list of how you would go about sanctioning the different individuals, the different accounts, things like that? So have you started thinking about that at all yet?
Thank you so much.
Well, let me say, the business of sanctions is entirely in the hands of the elected government and the Treasury Department. We are an implementer as it relates to banks. That's it.
Yeah, but we're going to take your advice on different aspects of this, Mr. Chairman. We're going to take your advice on the different aspects of this.
Well, I mean, honestly, when the sanctions were being put in place, Treasury was doing it. We weren't doing it.
Okay.
Yeah. I mean, that's the way it works.
Next question. There was an article again in one of the political newspapers yesterday, I guess it was, and it talked about the problem that we have here with the Fed's balance sheet. It says it now appears similar to a hedge fund whose long-term assets are financed by short-term borrowing, and the bottom line is that it's going to cost money. The Fed now has a negative income as a result of having to do this. And so it says here that the Fed will simply borrow the money to pay the bills. Is this true?
Yes.
That we're having the Fed's losing
and
money
you know
right
they'll
now
borrow
as a
from
result
us.
of the way
And then they'll make us pay them the debt on it.
The borrowings that you've
sick.
purchased structured?
The place I would start is that the Fed has, we always turn over all of our earnings in every year. We turn them over on an ongoing basis, and we've turned over something like $1.2 trillion in earnings just in the last decade or so. So
why did you make $1 trillion?
We always know that when we raise interest rates, you're going to lose money. And of course,
but you agree with the point that we have a negative income right now.
That's
and
right.
This makes my point to my next question, or my concern is, the CFPB gets their money the CFPB gets their money to run their agency from the Fed.
That's right.
So basically, there's no money for the Fed to pay the CFPB's bills if this is the case, unless you continue to borrow, which is basically what's going to happen now, is you're going to have to borrow money to be able to pay the CFPB's bills. Is that not correct?
No, we don't borrow money. We issue, basically, yes, we don't shut down the Fed when we have negative income.
Okay.
We can pay our bills and we can pay.
So my follow-up question
they just print the money.
Do you have any?
How do you pay the bills if you don't have money? Wait. How do you pay bills if you don't have the money?
Dollars at all?
He didn't answer that question.
No, we don't.
So they just get a blank check. You just told me they just got a blank check. They send you a bill, you send them a check.
Yeah.
There's no accountability for them.
I think there are limits built into the law, which I don't have.
I think he says that way too many times.
I have yet to see a limit, Mr. Chairman. I'd love to see what the limits are, because I don't think they've ever agreed that they have that.
You got to know when you're the man.
Mr. Chairman, I yield back.
Gentleman's time has expired.
You got to know when you're in control.
Foster, the ranking member of the Financial Institutions Monetary Policy Subcommittee.
Thank you. And just a quick comment. I think it's a mistake to imagine that you can completely hide from the macroeconomic effects of technology in your scenario planning. We just talked briefly about healthcare costs. Obesity is half of our healthcare costs, and there are treatments in these GLP-1 receptor agonists that look like they're just a home run against obesity. And so these will be near-term impacts which will have macroeconomic effects. So just a comment. I hope you have a certain fraction of futurists in the room when you're talking about your scenario planning, because a lot of that future is like now. Okay, back to economics. So we have this historically low unemployment rate, 3.4%. And historically, this would be considered to drive runaway inflation. Your predecessor, Alan Greenspan, repeatedly referred to dangerously low levels of unemployment. And yet we see inflation is coming down. So what is going on here? How can we have these historically low levels of unemployment without having inflation take off? Is it possible that we simply have less frictional unemployment in our system, due perhaps to the fact that people get their new jobs online and have a job lined up before they quit?
So inflation is coming down, but it's very high is the thing. And some part, I've never said all of it or most of it, but some part of the high inflation that we're experiencing is very likely related to an extremely tight labor market. Wages affect prices and prices affect wages, so I do think that's part of it. More to your point, though, there was a time when there was a tight relationship between inflation and unemployment. In other words, the Phillips curve was steep, and that went away over the period of the Great Moderation. And really, in our thinking, that's because people came to expect 2% inflation, and we had 2% inflation, and then people just stopped focusing on inflation, and it stayed very low. So there was really no relationship, or very, very tiny relationship. We could have very weak economic growth or very strong economic growth, and we wouldn't have inflation respond very much. That was before the pandemic, though.
Okay. Well, I hope you don't overlearn some of the lessons there. It's one of my worries that there have been a number of exogenous shocks to the system here, and it'll take a while to go through them. And if you want to be careful there. Now, in a related issue, when you say refer to the totality
you messed
of
up,
factors,
but I'm not going to call you
you're looking
out
at a
on
mixture of leading and lagging indicators. when you look at this totality of factors. And my question, if perhaps you might be paying too much attention to the lagging indicators and not enough to the leading indicators.
Amen.
You know, the example that's referenced in your remarks and is in more detail in the report about the difference between using current rental payments versus the amount that you pay for a new rental contract, and difference in how much they lag. Had you paid more attention, for example, to the leading indicators like current rental contracts,
hidden bullish on the 30-second,
then
so
you
could make a
probably
higher
would
than
have picked
that. Sorry.
up inflation earlier. You would have been, not gotten so far behind the curve on that. And secondly, there are policy implications going forward. If you look at current rental prices for new contracts, we're much farther along in fixing inflation, and that you can take your foot off the brake. And so what's your thinking on that, and whether you may perhaps be systematically not paying enough attention to leading indicators versus lagging ones?
So we've had our eyes on the whole housing inflation thing from the very beginning, and right now what I would say is that every forecaster is baking in lower rent increases. That's a big part of why people think inflation is going to come down in 2023. I think the thing with transitory was more had to do with goods, and it had to do with the thought that these supply side disruptions would go away much quicker than they would, that the labor market disruptions would go away much quicker than they did. And in hindsight, it just took much longer for those disturbances to go away.
Yeah. So with hindsight, and if you allow yourself to Monday morning quarterback yourself, you probably would have gone up to 4% earlier, and not had such a big problem with inflation. And so, what is your are there structural things you can contemplate, or even after action reviews to say what would have happened if we would have paid more attention to the leading indicators, or improve the in engineering term, improve the bandwidth of your feedback regulator? It's, this is something, if you want to get the best result, you need a high bandwidth feedback in the system, even when there's averaging on the back end.
So this is something we only think about during waking and sleeping hours, as you can imagine. It's really hard to know what the lessons are. Again, we really thought things would. Nobody had seen the supply chains collapse. No one had seen labor force participation plummet. We didn't know, or unemployment go to 14% and higher than that, really. We didn't know how long it would take to go away. And if we ever see this pitch again, we'll know how to swing at it. But it's been
we'll now recognize
a bunch of firsts. Sorry.
Gentleman's time has expired. The gentleman.
Wait, so his time includes the response time?
From Missouri, the chair of the Capital Markets Subcommittee, Ms. Wagner, for 5 minutes.
Hi, thank you, Chairman McHenry. And Chair Powell, welcome. Thank you for your service and for being here today. Yesterday, I was pleased to hear you discuss how inflation is severely hurting the working people in America. In your testimony, you also state that strong wage growth is good for workers, but only if it is not eroded by inflation. And that is key. Inflation is a tax, a hidden tax on every American. If the Federal Reserve were to shirk its mandates to stabilize prices, leaving inflation alarmingly high, what would it cost America's hard-working families in Missouri's 2nd Congressional District and beyond?
So I think the costs of failure to restore price stability would be extremely high, and while there will be costs to success, the costs of failure will be much higher. Mm-hmm. You'd be looking at an extended period where people learn to expect and live with high and volatile inflation, and it's very, very hard to have rising real incomes during such a period. So it'd be a bad thing for the country.
Can you reassure the committee that the Fed remains committed to bringing prices down for our constituents?
Yes, I do.
Thank you.
I hereby assure you.
And changing topics here a bit, as China's
if you said no, what would you
economy reopens and about 18% of the world's population resumes its consumption of oil and other key goods, what sort of inflationary impact will we see here in the United States, sir?
So a faster reopening of China, which it looks like we may be seeing, it does have the potential to put upward pressure on commodity prices, but it also would mean a faster sort of unraveling of the problems in supply chain. So those would be offsetting effects. I think sitting here today, we don't expect the net effect to be big.
Which is
for the
just
United States. It might be
that's
bigger
just
for other parts of the world,
what he
but
thinks and
we
what
think
I
it ought to be
think,
moderate
just
overall.
whatever, right?
China is one of the world's top oil importers.
What he thinks.
And do you expect any inflationary effects on global energy markets as China's oil consumption returns to their previous levels?
So I think oil prices could be affected, and I think that's a big concern in Europe, for example. We have our own domestic oil, and we've got a lot of natural gas as well.
We sure do. I wish we were actually harvesting more of that liquid natural gas. Chair Powell, you, Vice Chair Barr, and many others have recently identified that the banking system is well capitalized and strong. Bank capitalization remained robust during the shock of the pandemic and related shutdowns of economic activity. Capitalization of large financial institutions weathered severe stress testing mandated by the Fed. And despite all of that, as also previously mentioned by Chairman McHenry, Vice Chair Barr insists on conducting a review of capital rules. I'm concerned that this review is being conducted in a silo and that the findings will not be made fully available to the public. Taking such an approach in the context of this holistic capital requirement review would make it impossible to conduct a transparent rulemaking process, denying the public information necessary to consider and to comment. I think this is just simply not appropriate in this situation, and I'm concerned by the lack of clarity, I think is the best word, perhaps at this point, by the Vice Chair. A couple questions. You've served on the Fed board for over 10 years since the financial crisis regulatory framework has been put in place. And over that period, have you seen any real-world evidence that America's banks are undercapitalized?
So American banks are strongly capitalized, and I believe Vice Chair
Going over
Barr
this.
has said that as well. But
Yes.
the point is there haven't been any real
We
proposals.
talked about
to
it
evaluate
100
and when there
times.
are, that will be done in a highly transparent manner.
I hope so. I'm glad to hear you say in a highly transparent manner. Do you agree that excessively high capital levels constrain banks' lending capacity with spillover effects on jobs and living standards for Americans?
So I think it's always a balance, right? More capital means more safety and soundness and more ability to withstand terribly stressful periods. But it also, it's more expensive. Equity capital is more expensive. U.S. banks have competed incredibly well around the world.
Yes,
with
they have,
high levels of
internationally.
capital. So that's a trade-off that you're always going to be making when you think about capital.
Gentlewoman's
My time is expired. Yes, thank you.
We'll now recognize the gentlewoman from Ohio, the the ranking member of the National Security Subcommittee, Ms. Beatty. Ms. Beatty, for 5 minutes.
Thank you, Mr. Chair, and I like that title. To Chairman Powell, thank you for coming and being such a good colleague and friend. I have a couple questions I'm going to try to get through quickly.
Go try, get it done, baby.
Chair Powell, in a press conference last month, you stated, quote, "There is a lot of spending coming into the construction pipeline, both private and public, and so that's going to support economic activity," end of quote. How do you think the strong pipeline of funding from what the Democrats put together in passing the Inflation Reduction Act, the Infrastructure Investment Jobs Act, and the CHIPS Science Act will do to have economic activity this year and moving forward?
So I guess I was making the point that there are a lot of sources of demand that we can rely on, even though demand has been relatively increasing at a relatively modest rate. Part of it is...
Will this help in that demand?
Yes. I mean, there is state and local governments I mentioned are about...
So would you say this is a great thing that we've done coming from the left over
not
here.
Not for me to judge the merits of what gets done, but I'm just saying
But it will contribute
there that will support economic
and support
activity.
it.
Yeah.
So I'm going to assume from that that's a positive. Let me go to the second question. Chairman Powell, the Federal Open Markets Committee is projecting that unemployment will increase to 4.6% by the end of the year. And those costs, as we know, won't be borne equally. If we look at the ratio from the last time unemployment was 4.6% and compare it to our numbers now, it would mean that white unemployment would go up to about 0.9, but black unemployment would go up by 2.3%. Does that sound somewhat accurate to you?
Yes.
Can you address the disparity impact with that? And before you answer, let me go to the book and thank you that was put at our places together. You made in this book with your signature on, it is stated, however, while disparities in unemployment have largely returned to pre-pandemic levels, there still remains significant disparities in absolute levels of employment across groups like African Americans and Hispanics. So can you address that?
I can. So right now, to your point, actually, African-American unemployment is, I think, 5.4%, which is just about as low as it's been since we started tracking it in 1972.
But differential from majority by...
I'm going to say, so that's 5.4, whereas the overall is 3.4, and that includes blacks, so that means for whites is well lower than that. What happens is, so there's a persistent gap between black and white unemployment, and also, when unemployment goes up quickly in a recession, it goes up much faster for African Americans. When the economy grows again, it comes down faster. So that's somehow embedded in our economy. We don't really have the best thing we can do is achieve stable prices so that we can have long expansions. And what happens in those long expansions is that the labor market gets tight, sustainably tight. And we have historic lows in unemployment, including for African Americans.
Let me say thank you, and let me also again thank you. As you know, in the 117th, I was the chair of the D&I committee, and let the record state that you always pushed for making sure that you understood and respected that. And in that, this is very minor and certainly personal to me. In this report, maybe those who helped you author it, I would like to see the areas that talks about unemployment not under a title of special topics, but something that draws a little more attention to it as some of the others, just very minor. Last question I have. Can you tell me if the Feds is committed to working with the other agencies like the FDIC and the OCC to finalize a rule soon on CRA? Certainly that's something of great interest to many of my colleagues. So can you give us any updates on it or how the process is going or what we can expect?
Yes. So with Governor Brainerd's departure for the White House, I've asked Vice Chair Barr to take the lead in moving it forward. I would characterize it that there's essentially agreement between the three banking agencies on the changes to be made. That's all being written up and vetted, and at a certain point, members of the Board of Governors will be briefed on it. We'll vote on it.
Is there anything we can do to help with that?
No, I think we're hard at work on it, and it's going to take some months, but I think we're nearing we can see the airport, and we'll be landing in a few
Gentlewoman's time has expired. The gentleman from Kentucky, the chair of the Financial Institutions and Monetary Policy Subcommittee, Mr. Barr, is recognized for 5 minutes.
Thank you, Chairman McHenry and Chairman Powell. Economic data are mixed, as you know. On the one hand, low unemployment, robust hiring, strong consumer spending, and persistent core inflation, and a CPI that's still more than 3 times your 2% target suggests more aggressive tightening is warranted. On the other hand, because the Fed misjudged the inflationary impact of Democrats' overspending, kept interest rates too low for far too long,
thank you for the super chat,
failed to end quantitative easing
God
soon
bless
enough,
you.
The Fed has been forced to raise the Fed funds rate 450 basis points in just 11 months and reduce the M2 money supply at the fastest rate since the 1930s. As a result, wage gains have slowed, credit card debt is at an all-time high, the housing market is in a slump, and the yield curve is inverted. I agree with you that the historical record cautions strongly against prematurely loosening policy. But what would you say to those who caution about the lag effects of monetary policy, the precipitous decline in liquidity? Will the economy have to suffer a recession in order to bring inflation down to 2%?
We are very well aware of the lags with which monetary policy affects economic activity and inflation. Those are long and variable, and I would stress highly uncertain. There is really no agreement on exactly how long they are, but we know that slowing down the pace of rate hikes this year is a way for us to see more of those effects as they come in.
In December, most Fed officials expected to lift rates this year to between 5 and 5.5%. Is that still your estimated terminal rate, or does the data suggest that the terminal rate could be higher than 5.5%?
My colleagues and I will write down new forecasts and release them to the public on March 22. But as I mentioned in my testimony, the data we've seen so far this year suggests that the ultimate level of rates will need to be higher. But we still have some more data to come in between now and the meeting. But as of today, it suggests a higher level than that. Let's
go to Vice Chairman Barr's review of the capital framework. A lot of questions for you on that. When Governors Brainerd, Quarles, Clarida, Bowman, and Waller made up the board under your leadership, major changes in policy were addressed following board consensus and not when there was significant dissent. Will you commit to not implementing a new capital framework following this holistic review or the Basel endgame if there is considerable dissent from the board?
I can't really commit to that. We are a consensus kind of an organization, and that's what we'll work toward. But ultimately, we
would that be a break from your prior practices? You're a consensus builder, Mr. Chairman. You pride yourself in that, and we credit you for being a consensus-oriented chairman. Will you commit to continuing that practice and not allow major changes to the bank capital regulatory framework to be made by one person?
They can't be made by any one person, but I do commit to that, and I commit to doing everything I possibly can to bring people together in consensus, to have something that can be broadly supported.
Thank you. Earlier this year, you said, and I quote, "We are not and will not be a climate policy maker." However, in the Fed's draft principles on climate-related financial risks, one proposed principle suggested that boards of directors or of a financial institution should consider making changes to its compensation policies to align with values in the context of supposed climate risks. It appears then that the Federal Reserve, through regulation, wants to begin implementing climate policies. So which is it? There seems to be a disconnect between your statements publicly and the rules that the board is putting forward for comment.
Bear flagging down.
Well, I feel strongly that climate change is an important issue that needs to be addressed by elected people. It's just not something that we've been charged with by Congress, clearly. So we do have a narrow role, and that role will be around making sure that banks understand and can manage the risks that they're running, and that's going to be it. And I, as I said before, we don't want to drift into becoming a climate policymaker, and we'll have to guard that border very carefully.
Regarding the Fed's climate scenario analysis pilot program, did the board vote to approve the creation of that pilot program?
I have to check, but I don't think so. I think it was already authorized.
And this is a concern that I have. I'm concerned that one governor acting unilaterally to implement major policy changes without board consensus is a problem. And so I would urge you and your colleagues on the board to continue a consensus-oriented approach, and I yield.
Gentleman's time has expired. We'll now go to the ranking member of the House Intelligence Committee, Mr. Himes of Connecticut, for 5 minutes.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Thank you for your careful conduct of monetary policy, independent of the many political desires that circulate in this building. Independent monetary policy is a bedrock of a solid economy. I want to reflect for a moment on another bedrock of the American economy, the full faith and credit of the United States government, which is now being put at risk by the Republican majority. My Republican friends know how very dangerous a game they are playing. They know that salary payments to our soldiers are at risk. They know that their irresponsibility will raise mortgage rates for new home buyers. But they say this is the only time we focus on spending in the debt. which of course is baloney. It's a pernicious form of baloney. The time to focus on the deficit is when you are voting for the spending and the tax cuts that create the deficit. When you're voting for the Trump tax cuts, which the CBO said would add $2 trillion to the national debt, that's the moment to consider whether you want to do that. Not when the good name of the United States is hanging in the balance. This stuff gets a little complicated, but the American people really need to understand what's happening here. The Congress sits down to a huge 10-course meal of tax cuts and spending and more defense spending and expansion of this program and stimulus, all of which we vote for collectively. First course, second course, white wine, red wine, 4 servings of dessert. And then the bill comes and my Republicans say, whoa, wait a minute, hold on, look at this bill. This is irresponsible. Do we really want to pay this bill? That's not the moment for the consideration. The moment is when you're ordering 4 helpings of dessert. That's when we should be talking about it and taking responsibility for the choices that we make without putting the full faith and credit of the United States at risk. Now here's where the hypocrisy comes in. My Republican friends like to point the finger at this side of the aisle and blame us. But Chairman, as you know, fully 1/4, 25% of today's United States debt was accrued in the 4 years of the Trump administration.
It's got to be white.
This country's been around for 246 years, and fully 1/4 of the United States debt was accrued under President Trump. By the way, speaking of hypocrisy, in the 4 years of President...
You know what's crazy is that he's talking about hypocrisy, right? And I'm not Democrat or Republican, as I said, I have my own party. But look at this, right? If you look at this clearly, let's just break down what he said for a split second, and we'll jump back into the live because he's clearly muttering. But it's going to be this, right? They were printing money. Every year, the dollar was going down in value. And every year, you had to print more money to do anything in government. So everyone that gets into government is going to be someone, and you look in the past, someone that had to spend more money or print more money to get anything done. So I'm not trying to defend Trump or anything. I'm just saying it didn't matter who was there. Like, they had printed so much money that you would have to print that money. Also, our army was horrible, right? Like, there was so many things that needed to be done for America to become, like, I don't know, in my opinion, to kind of clean up what was going on. So, I don't know, it depends on how you look at it, right? But it also, there's a little bit of hypocrisy there because anyone would have had to have print more money.
President Trump, the debt ceiling was raised or suspended 3 times. I didn't even notice. But now, of course, we have a different president, and so the calculus is different. Now, Mr. Chairman, I don't think I'm going to persuade the majority to act responsibly here. I actually think the markets
raised by
they're
Congress.
all going to keep printing money.
There are no other,
doesn't matter
no
on what
rabbits
side
in
they're
hats,
on. That's
as
what
I
I keep
mentioned.
telling everybody. It doesn't
and
matter.
Also that no one should assume that we, the Fed, this is the Fed's business, is to protect the economy from various events. And
can we bounce off this retest here
no
at 22,115 is the question.
To protect the highly uncertain effects of that kind of an event.
So monetary policy is obviously very concerned with interest rates. If global capital markets begin to decide that we're really serious about hurting ourselves this time, is it possible that we could see interest rates rise more because borrowers of United States debt decide that we're actually a little risky? Is that possible?
I think that and many other things are possible. The thing is, we've never crossed that line, and if we cross that line, we're going to find out, and I think it's highly uncertain.
Okay, so that's possible, and I don't like pressing you on these things, but you said this and many other things are possible. You want to elaborate on what might be in the category of many other things?
Rather not, actually.
Okay, I figured. All right, thank you, Mr. Powell. Again, I really thank you for your really responsible conduct of monetary policy, and there's a reason that you are insulated from our political desires, and I very much appreciate that, and yield back.
Gentleman yields back. We'll now recognize the chair of the Small Business Committee, Mr. Roger Williams of Texas.
Thank you, Mr. Chairman. And Chairman, it's good to see you. Always good to have you here.
It's good to watch government.
Past congressional testimonies, you've repeatedly
we understand what
that you
goes on
support protecting the state-based system
behind the scenes
of insurance regulation, which is the most effective and competitive in the world.
Nice talk.
My home state of Texas is the world's 7th largest insurance market, proving the success of this system. Now at the International Association for Insurance Supervisors Conference in November, there is the opportunity to have the U.S. state-based aggregation method become formally recognized as comparable or equivalent to the insurance capital
Market
standard.
is flat right now.
We should not be following the European model that has increased regulations and less competition, and we should prioritize a model that encourages deregulation, competition, and less government involvement in pricing. So my question is, Chairman, can you highlight the benefits of the U.S. state-based aggregation method compared to the European model regarding market resiliency and systematic risk? And can you confirm that you will push for aggregation method to be deemed equivalent by the IAIS?
I can say this. I do think that our insurance regulatory system has proved itself appropriate and adequate and gotten the job done for a long time, and we don't need to be copying other countries or other regions' insurance regulatory system. I'm a little rusty on the details of the capital requirements, but that sounds right.
But our bottom line is our side works, the other doesn't. We need to stay where we are.
Our side works.
Yeah, thank you. Also, in the past, you stated that banks were well capitalized. We've talked about that today, but now there have been increased conversations about raising capital requirements. Numerous economic studies have found that raising capital requirements for banks will increase borrowing costs for their consumer and commercial customers. And I'm somebody that's owned 50 years. I've never had a day I wasn't out of debt, so I'm concerned about this. And implementing additional regulatory capital requirements will slow economic growth and limit financial institutions' lending ability. So do you believe that raising capital requirements would raise the cost of borrowing and add cost to our economy in Main Street America?
Well, it depends on which banks experience higher capital requirements, and there isn't any proposal to evaluate right now, of course, but it's always a trade-off. You know, higher capital is good in a sense because it keeps banks able to lend during bad times. That's really a good thing. Too much capital, though, probably limits credit availability, so we're trying to strike that balance always.
And this has been touched on a little today, but let me come from a different angle on it. But the Reserve was created to act as a nonpartisan entity that remains separate from party politics. Talked about that. And unfortunately, throughout recent years, the Fed has gotten caught up in politically charged issues like economic inequality, gender and race discrimination, and climate change. Recently, the Federal Reserve Board proposed guidance on managing climate-related risks for large banks, further proving that the Fed is giving in to some political pressure and operating outside its intended purpose and responsibilities. So our country's financial leaders, in my mind, should be focusing on addressing runaway inflation instead of worrying about the financial institutions are doing to monitor climate change. So, and we touched on this a little bit, but how can the Fed ensure that they're not placing undue regulations and guidance on banks by forcing involvement in partisan green politics? And how's the Federal Reserve ensuring they remain separate from political influence?
I think it's absolutely critical that we do. I mean, our independence is partly founded on the idea that we will stay out of stuff that you have not assigned us to do. And if we're going to wander all over and take on the hot issue of the day, our case for our independence is dramatically weakened. On climate change, I think we do. You mentioned the guidance, and then there are also the stress scenarios.
He walks a line here.
Those are the two things that we've done. We've tried to keep those tightly focused on the banks, understanding and being able to manage the risks that they'll run over the longer time periods on climate, and not slide into a broader sort of policy making role on climate change. And I accept that could be a slippery slope and a moving border. And I just want to say, and I think my colleagues feel the same way on the board, that we're going to guard that border carefully, and we're going to stick to our role and not try to be policymakers the way in many other countries the central bank is out there in the lead with the support of the public doing climate policy. But that's not where we are in the United States, and we're not going to pretend that it is.
I've got some time left, and I'll yield back, but I just want to say as an auto dealer, I'm looking for the first day of that rate cut. Done with that? So, thank you for being here. We appreciate it.
Gentleman's time has expired. We'll now go to the gentleman from California, Mr. Vargas, for 5 minutes.
Thank you very much, Mr. Chairman, and again, thank you for holding this hearing. Chairman Powell, a pleasure to see you again. I've said it before, and I'll say it again. It's always great to see you, because I always think of the old Republicans, the ones who are very noble, did the right thing, didn't play chicken with the economy, very forthright. And so anyway, I appreciate you being here very much. Like some of my colleagues on the other side, I'd say the same thing about some of them, and I appreciate you. So we heard today that the inflation is Biden's fault. So what is the inflation rate in the European Union today?
It's high.
It's high. Is it 10% possibly?
I think if you're talking about headline, I don't have this figure in my head, but it's very, very high from a headline standpoint. And they've had core inflation move up too.
I mean, how about,
so are they following Biden's then policies? Is that what caused the inflation? Because it seems to be Biden's
no, we've
fault.
been printing money for the last 20 years, man.
Inflation is everywhere.
Inflation is everywhere, like he said.
It must have to do with a common factor, and
it's
that
not
common
one
factor
person.
has to be the reopening of the economy after and the things that were done on.
That's why when Joe Biden said inflation was transitory and he was blaming it on things,
on the other hand, each country
shouldn't have done
has a
that
little
either.
bit
He should have said,
different
"Hey,
pace.
inflation has been around. They've been, governments have been printing money," but he didn't. I guess you can't say that. You know,
now they
that's
have,
what the truth is.
Their inflation looks a lot like ours did a year ago.
Right. Yeah, I just had to bring it up because, again, Mr. Sherman brought it up, but it's interesting every time I hear inflation is caused by Biden, I wonder why is it all over the world? I mean, it's not because of the pandemic, of course, or, Europe's at war. I mean, that wouldn't cause it, of course. It'd have to be Biden's policies. That's ridiculous. And I think the voters saw through it last time. So I haven't been here 15 years as my good friend, Mr. Foster. I've only been here 11. But when I first got here, the boogeyman, and I heard it all from my friends on the other side, was Dodd-Frank. Dodd-Frank was going to be the end of banking. And in fact, some of my colleagues would almost scream how horrible this was. And then we got the bankers up here during a real stress test, which was the pandemic. And we asked them, has it been helpful to have Dodd-Frank? And you know what they said? Do you know what they said?
I don't.
Oh, they said it was helpful. In fact, it kept the banks capitalized. It was fascinating. Now, to be fair to them, they did complain about some of the smaller issues, but not Dodd-Frank in general, the bill. Then it seemed that CFPB, that became the next boogeyman. But they're starting to
Your time is up.
seem to fade on that, and I think the reason for
Your
that
time
is
is up.
CFPB has actually helped so many people.
Guy
And now a lot of their own constituents now are getting helped by the CFPB, so all of a sudden there's not quite the energy. So now they're attacking ESG. And they're saying that you and everybody else is somehow conspiring to make sure they don't buy their oil or their coal. Are you conspiring to do that? Are you conspiring?
I don't believe we're conspiring.
No. Now, I heard it was supposed climate risk. Is there risk in the climate change?
Yes.
There is? Could it affect the bank?
Certainly, in the longer run, yes.
Yeah, of course it can. Do you think insurance companies take this into account?
Yes, actually, I believe they do.
They absolutely do.
Who write long duration liabilities, they certainly do.
Of course they do. I mean, they're very concerned with it. Weather is a big deal. I was the vice president of Liberty Mutual in their corporate legal department, and I can tell you weather and the changing of the weather, we used to have what we call...
Oh, just so you know, I just want everyone to know who I am, what I've done. You notice, like, the other people just ask their question. The pretentious people always want everyone to know, like, look what I've done. Look what I've done. Like, look, I was this and I done that. And it's
all
just like,
catastrophes.
man, for his 5 minutes of asking someone, was that really worth it to let us know what the heck you've done in your life? No, ask the man a question and move on with your life.
50, 100 years. Now those 25, 50, and 100-year events happen every 5 years, every 2 years. So of course it is. I mean, it's ridiculous not to take a look at these ESG factors. We have to. And again, I'm glad that you guys are taking a look at it because it's real. I'm glad that, the president's taking a look at it. And it's sad that my colleagues on the other side just want to stick their head in the sand and say, no, climate change is supposed climate change. No, the reality is it's real climate change, and it's costing billions and billions of dollars. And if you don't believe it, go ask all those poor people in Florida that had those huge hurricanes come through and wipe them out. So again, I appreciate very much the work that you've done. The only thing I hope is, as you said, if we ever see this pitch again, we'll know how to swing at it. And I hope we don't get the pitch of defaulting, because I'm not sure we'll know how to swing at that one. So thank you again, Mr. Chairman. Thank you for being.
Thank you.
I yield back.
Gentleman's time. Gentleman yields back. Gentleman's time has expired. We'll now go to the chair of the Oversight Subcommittee, the gentleman from Michigan, Mr. Heisey.
This guy's like, I need a sandwich. Look at him.
Thank you, Mr. Chairman. I'm going to move quickly, and good to see you again, Chair. I caught a little bit of the Senate hearings yesterday, and you had a lot of pressure to keep the sugar high going. And frankly, if the Fed and many of our colleagues had listened to what many of us were saying, we should have been weaned off that artificially low, cheap money that kept the party going, and frankly, we wouldn't be in this position. To reference Chair Greenspan's punch bowl analogy, not only did no one have the courage to remove the punch bowl, you had people cheering on the pouring of another bottle of 151 rum into the punch bowl. And here you got folks wanting to do the exact same thing. Let's spend more. It's just, and now here we are. You have an impossible decision to slow the economy or let everyone get crushed by inflation. And we know tightening means a slower economy. Slower economy means fewer jobs. Fewer jobs hit those who can least afford to lose a job. And so in short, the lower rungs of the economic ladder will suffer more than the rest of the ladder.
Yeah.
So that's the state. That's the state of
exactly
where
what
we're
happens.
at. I have to hit a couple of quick issues here.
It's not right.
I wanted to start off by discussing climate, especially given the Fed's announcement in January that it was going to conduct a pilot climate scenario analysis exercise. The Fed, along with the OCC and FDIC, have each issued proposed climate risk management principles for banks that you are attempting to finalize those by the end of the year. And the requirements don't stop at the border. The UK and the EU central banks are moving to require significant ESG disclosure regimes as well. I know the Fed is taking a look at commodities capital charges in the holistic review, but even though the Fed isn't forcing banks to encompass climate analysis in their stress tests, there are many initiatives at the Fed that are going to make it more costly for banks to finance traditional fossil fuel companies. So I want to ask you a very specific question. Will you commit that you will withhold support for a new capital rule that increases capital charges on bank activities in traditional energy companies?
You know, I can't,
Say again?
I can't sit here and promise what I will and will not vote for because I don't know what's going to be in the proposal, but that's not the kind of thing we're looking at.
I'm sorry, it's not the kind of thing?
So this isn't about, this is about overall capital levels more than anything else, I think, rather than the specific thing you're talking about.
Okay. We're going to follow up on that because we need to have a real-time conversation about what that is going on there. I want to quickly switch topics and go in a different direction for this next question. I want to ask you about two opinions issued by your legal staff in November of 2019 and December of 2020 to the asset managers Vanguard and BlackRock. Mr. Chairman McHenry, I'd like to submit the two letters for the record.
Without objection.
Thank you. These opinions appear to outline the parameters of both how both Vanguard and BlackRock can operate without being deemed a bank holding company. In addition to the legal restrictions outlined by the bank holding company, these opinions listed out here in quite detail list out commitments that the companies would need to take to avoid being viewed as having, quote, control. These opinions also appear to provide assurances that the Federal Reserve Board staff would not recommend that the board find the asset managers to be bank holding companies. Further, it is unclear whether the board will take any steps beyond a periodic self-certification by the asset managers to monitor compliance with the condition that they, quote, not take any action to control a banking organization. As some asset managers play a larger role and clearly strive to influence policy in companies across the free market, we need to remain vigilant. So, Chair Powell, is the board taking any steps to assess or monitor whether Vanguard and BlackRock are complying with the commitments made in November of 2019 and December of 2020, respectively?
I would have to check and get back to you on that.
Okay.
Familiar with the
He'll never remember that.
But that says to me that doesn't sound like there's an assessment that's taking place ongoing or scrutiny of that. Is somebody reviewing that or is someone in charge of reviewing that?
Honestly, that's a very specific, narrow question. I'm quite familiar with the issue.
Well, it's specific and narrow to two companies, but not to an industry. I mean, that's what we need to be driving at. And I guess we need to find out whether there's somebody proactively reviewing these activities and these commitments that the companies have made as well as the Fed has made. So how often do you think they should be reassessed? Annually, monthly, biannually?
This is a This is a very narrow set of questions. I can get you great answers really easily, but I don't have them in my head.
I look forward to those great answers, and I yield.
We'll now go to the gentleman from New Jersey, Mr. Gottheimer, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell for joining us today.
Can't take
Chairman
the hard
Powell, when you
questions.
testified before the committee last June, PCE inflation was up 6.3% year over year. Just a few weeks ago, PCE data showed that the numbers decreased to 5.4%. We're moving in the right direction, but despite the Federal Reserve raising interest rates at the highest rate since October 2007, we're still far off from the 2% inflation that the Federal Reserve is targeting. Do you believe 2% is still the right target for inflation? And given the ongoing energy transition, the push to shift supply chains out of China, and the labor shortage here in the U.S., should the Fed consider adjusting its target to avoid overly burdening Americans? Would a decline to 3% inflation be enough to offer price stability without excessive economic pain?
No, 2% inflation is going to remain our longer-term inflation goal.
I don't understand how it
Are you
has to
concerned
be a
given
number, even
all
though
the other factors
change.
that I mentioned, or you think we just have to keep sticking with that?
I think that's got to remain our longer-term inflation goal. It's the global standard, and it's our standard, and this is not a time at which we can start talking about changing it. We have no instinct to do that.
Thank you, Mr. Chairman. The gig economy has grown significantly in recent years.
I'll make you all poor, and you'll all just
as contractors
have nothing, but
or
we'll get to
running
2%.
small businesses. The Dallas Federal Reserve has written that gig workers are often not included in payrolls and not counted among the unemployed, and this may understate the number of Americans who could be counted as unemployed. The Fed has also noted the large number of Americans who are missing from the workforce after the pandemic. Do we need to change the way we think about measuring unemployment to account for these changes?
I missed the word you're saying.
Sorry, do you think we need to change the way we think about measuring unemployment to account for these changes?
I didn't catch this. You said, what was the word?
Gig. Oh, sorry, gig. Gig
workers.
Yes, I'm sorry.
I didn't
Gig
hear
workers.
Gig.
That's the word I didn't hear. Okay.
Oh my
We
God!
clearly
Don't even
need
start.
to
You guys
incorporate
know.
gig workers both
Don't do
into
it.
the labor,
Don't do it.
The labor force
I know
and
you
to
know.
whether they're working, and they certainly are working. We try to do that. It's not that we're not trying to do that. We may not be doing it perfectly.
Is there a better way to capture them? Just worried that you don't have the unemployment numbers may not, given we're still using older measurement ways. Are we updating our measurement?
We absolutely try. We're definitely trying to get those people, self-employed people.
Why'd you do that? Don't do it.
Report in the household
Jerome,
survey.
man, you're gonna get
I
flagged.
can get more
man.
for you on that.
Flag them.
I'm sure we're not doing a perfect
Flag
job
'em.
because it's a relatively new thing, but we're very well aware of it, and they're supposed to be included.
That'd be great. I'd love to talk to you more about that.
Great.
Thank you. As you're also aware, many of us are having discussions about the long-term fiscal health of our country and our economy. Like many, I worry that higher interest rates will put upward pressure on the national debt. CBO already estimates that annual interest costs will nearly triple for the U.S. over the next decade. You said to the Senate yesterday that interest payments are not a consideration of the Fed, but are you concerned that higher interest rates will more rapidly make payments on the debt unsustainable? And are there
Rich
actions
man, you're
Congress
out.
should consider to address
Anyone
this
who is
issue?
immature enough to do it, you're out.
I'll say what my predecessors have said, which is that we're on an unsustainable
You gotta
path.
be out.
And
You can't
we really
do that
need
stuff.
Ultimately, we will get back
Gotta
on
be
a
better.
sustainable
You
path.
gotta
And the
act
sooner we
better.
get to work on that, the less
Shout out to
painful
Justin
it will be.
Cashmore.
And rates, of course, were low between the financial crisis and the end of 2021, particularly low.
Get 'em outta here, Kevin. Get 'em outta here.
What do you think the new normal looks like in terms of rates and the Fed balance sheet over the next 5 to 10 years?
It's a really good question. There was a secular decline in longer-term interest rates, which we don't control.
Gotta
for
wear a
40
white
years,
shirt
to
today,
the
a
point where
white
they were,
shirt.
where the 10-year
Solid
was-
tie.
was
I went
10-year
against the
treasury
rules.
Was at 10%, and then at the end of
But
40
I'm a
years, it
news
was
guy.
low.
I'm not like these guys.
You're at higher levels. You're at, as you pointed out, levels we haven't seen since
Today,
since
I'm a news
earlier
guy.
in this century. I don't think anybody knows what this is going to look like 5 years down the road. So you have to ask, demographics haven't gotten better. Globalization may actually move a little bit in reverse, which would tend to produce higher inflation and thus higher rates. But you have to ask the factors that caused low rates, how much of that has changed. And some of it has, but much of it hasn't.
Building on that a little bit, what's the right metric you think for, if you're in our shoes, for assessing our
I'll
fiscal
see you,
health?
Justin.
Do you think we should be focused on maintaining a specific debt to GDP ratio, or is there a specific number? Are there other measures lawmakers should be focusing on?
So we've traditionally focused on debt to GDP, but many people pointed out before the pandemic that rates were secularly lower and that therefore you could look at sort of real debt service. There was a lot of research on that. And by those measures, actually, debt service was much more easy to handle. Now we have the 10 years back close to 4%. And I think we need to be careful not to assume that these secularly low longer-term rates are going to continue indefinitely, because that doesn't look likely now. And frankly, most forecasts have always shown things like the 10-year going back to a higher level. So it won't be that big of a change. I think.
Excellent. Thank you so much, and I yield back. Thank you.
Thanks.
Now I'll go to the gentleman, the Vice Chair of the Digital Assets Subcommittee and the Chair of the Housing Subcommittee, Mr. Davidson of Ohio, for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you. It's an honor to be able to talk with you today and appreciate the work you and the monetary policy-focused portion of the Fed does. We're rooting for maybe a more consistent input from our bank regulators. So for the regulatory side, I've spoken with multiple bankers who tell me that they've never seen a higher degree of regulatory burden, steering, guidance, shaping activities in the market from regulators. Now, I don't think that's just narrowly focused on the Fed, but I'd ask you to look into it. There are a lot of people that feel like there's not Operation Choke Point 2.0 going on, and it's particularly focused on debanking people that are disfavored by the current executive branch primarily, just like the previous Operation Choke Point was. And so to the extent that you yield any influence over the regulatory component of the Federal Reserve, I think that would be meaningful and important because our monetary system, part of the strength of the U.S. dollar is, of course, a stable store of value. Currencies around the world are wrestling with that and inflation, and you guys are working to tackle it. But the other part is it's an efficient means of an exchange. And when people really feel like some third party is going to steer or shape their money, they don't trust it. I mean, the unbanked and the underbanked, fundamentally, that's lack of trust is part of why they don't use our banking system today. In fact, that's part of the appeal of the digital asset space, is the permissionless nature of it. It seems that a lot of people in the financial services space that have grown up in it, that are leading it today, feel threatened by the prospect of change. And if they've maybe reluctantly concluded that you can't ban crypto, they at least want to keep it account-based so that some third party can actually control the assets, which is a polite way of saying we don't actually trust our citizens to control their money or their assets. We'll let somebody else do it for them because we can control those third parties. And in fact, that's what the regulators do, isn't it?
Isn't what?
They control the third parties. I mean, if you don't comply with the regulatory regime, you don't get to operate a financial services business, right?
That's right.
Yeah. And so at the end of the day, I think a lot of people were concerned by your remarks yesterday. I know I was, by saying that permissionless digital assets pose a systemic risk to the financial system.
Well, what I think
it's not true.
What we said in our guidance. I think if you read through the digital guidance, which I did getting ready for this hearing, of course I read it before we put it out the first time, but
no, you didn't. You just read it the first time, but you just had to catch yourself full of garbage. You're the liar, man. Oh, of course I read it before then, but
incumbents and things like that.
The first time he ever read it. He just admitted the first time he ever read it was before this. Like he caught himself.
I think it essentially goes to the question of protecting the safety and soundness of institutions.
That was classic.
And there is one. I think what we say about
that was great.
I'll paraphrase it. What we say about permissionless.
You can't make that up.
Changes is that they have been.
Get someone to talk enough, they're going to mess up.
Yeah, 0.24%. So if you follow your own report on fraud, it's a fraction of what it is with the U.S. dollar. Speaking of the dollar, is there any real current threat to the dollar's preeminence as the world's reserve currency?
You're asking a question. I didn't.
Yes, sir.
Is there a real threat?
Is there a threat?
I think that our status as the world's reserve currency is not under particularly strong threat right now. I think it's a pretty stable equilibrium. It's not a permanent equilibrium, but there isn't really a serious competitor, and that's not because of any of this. It's because of our democratic institutions and the rule of law, and the fact that the dollar's value is
the rule
stable.
of law.
Okay. So quickly on the repo market, just any insight into that, and then I'll have my last comment here and just leave the last word to you.
This is my Maddox short making
gains.
About
the repo market, but I'll close by simply saying I'd ask you to turn off the purchase of mortgage-backed securities. As the chairman of Housing and Insurance, I'm particularly concerned about affordable housing, and the artificial prop for the mortgage-backed securities does raise the cost of capital in that space. So whether you own it or occupy it or rent it, it's going to raise the cost there. But I'd just ask if you'd comment on the safety and soundness of the repo market, if you would.
Of the repo market.
I like how he's saying that. No one's mentioned that.
It's functioning reasonably well these days.
Reasonably.
You're talking about the reverse repo facility? Or
yes.
Yeah, after September, we were about to go down.
Reverse repo facility is a different thing. We can continue this.
I'd like to follow up with you later, and my time has expired. I yield.
Thanks.
He's like, I'm not going to talk about
Gentleman
that.
from
to the
Illinois,
public.
Mr.
That's
Casson's
something that
recognized
will
for
scare
5
everybody.
minutes.
We can't get into that.
Thank you, Mr. Chair. Always a pleasure to see you, and appreciate your time here today. I want to start with this chart in your monetary policy
Grandpa
report.
Powell. Everyone loves
Chart
Grandpa
14 on
Powell.
Page 17. This is this
Uncle Powell.
history of wage growth and job growth. And for those of you who don't have it in front of you, broadly speaking, from 2000 to 2017, we had more workers than jobs. From 17 until the COVID crisis, it was about the same. And since COVID, we've had more jobs than workers. And there's tons of rich stuff in here that I just enjoyed reading.
I keep saying there's more jobs than workers. They're saying we have the
if
highest unemployment rate since the. I mean, I look around and I can still see people help wanted. It's not the same as it was even 7, 8 years ago. And once the pandemic, it's never been the same. I don't know about you. Let me know in your neighborhood. We're gonna put a poll here.
If that was the only thing going on in the economy,
we're going to ask you a question in the poll
we
here.
had 20 years where it was essentially a buyer's market for labor, and the last year and a half where it's been a seller's market for labor. As you look at that, and if I go
start
through
a Q&A,
and I look at
answer
from
viewer
2010 to
questions live.
2020,
This is new.
CPI was up 20% over the period.
I want to do that.
And real median wages less than 10%. So for half of the economy, they didn't keep up with wages, even though we think of that as a very low inflationary period. Corporate profits were also up strongly, as you would expect. I'm not saying that with judgment, right? If it's a buyer's market for labor, you would expect the gains from labor productivity to flow to consumers and profits, and that looks like what it did.
So do you feel that unemployment is up or down in your neighborhood? Do you feel unemployment is down in your neighborhood? Yes or no? I feel like it is. I don't think it is down. I mean, it is. Do you feel like unemployment is down in your neighborhood? Yes or no? Let me know. I want to know what you guys think. I don't think so. I don't feel it.
This is chart 14 on page 17 of the monitor. It's the top right corner there.
Got it. Okay, thanks.
In the last year and a half, median wages are up 5%, which is almost as much as they grew during that 10-year period before. And yes, inflation is still a bit higher than that. But what I'm wondering is, as you look at the economy, is wage growth universally bad in your view, or is wage growth good to the extent that it's keeping up with wages? Because historically, wages didn't keep up. And how do you think through that nuance? Because interest rates are a very blunt tool. And if you agree with me that we're now basically in a seller's market for labor, shouldn't we expect and welcome some wage inflation that goes with that?
So I'd say two things. First, we want wages to go up in ways that are consistent over time with the increase in productivity and inflation, and that makes all the sense in the world. The other thing I would say is that in this instance, what we've seen is inflation eating up these very high nominal wage gains have very largely been eaten up by higher inflation. So it's very important that we restore price stability so that we can start to see real wage gains after inflation across the income spectrum.
Yeah, no, and to be clear, we're all opposed to inflation here, but in that 2010 to 2020 period that we all viewed as a very low inflationary period, the gains from productivity did not flow to labor. Wages did not keep up with inflation. And we didn't think about that as a problem for the Fed to fix because overall inflation was down. So,
possibly,
this gets sort of theoretical, but let's say that we had 6% wage inflation and 5% CPI. There'd be more money in people's pockets, but would we view that as a inflationary period to clamp down on? Because we didn't view the inverse as a problem, if you will.
So our job is to restore price stability and keep price stability. It isn't to keep wages down, and it's certainly not to get involved in trying to establish the appropriate level of labor
Got our
share
cup and handle
profits,
again.
for example. That's not the way we think about it at all. We think about price stability, and when we think about price stability, we think about wages as an important input to that. But we're not targeting a particular level of prices, and we would never say that we don't want real wages to go up. What we're really charged with is price stability, and to do that, we have to think about wages. But in particular, no one at the Fed would be upset to see the labor share go up, but that's not something that our policies affect. That's set by globalization and the advance of technology and educational and skills and aptitude and all those things. That's what drives and productivity. That's what drives labor share.
Yeah, and it's hard to have these conversations in 5 minutes, I realize.
Happy to follow up.
I guess what's hard is
he's
that,
had more
also
than 5
in that
minutes.
2010 to 2020 period, median home prices went up by 50%. Yeah. We didn't view that as inflationary. 401ks went up a lot. We didn't view that as inflationary because those were asset increases. And so as we have shifted the gains from people who had wealth to people who were dependent on wages, there needs to be some correction, and I leave it there because I'm out of time. But how we think about that.
Gentleman's time is
Thank you.
expired.
Go back.
We'll now go to the gentleman from Tennessee, Mr. Rose, for 5
He
minutes.
knew his own time. See, you
Thank
should
you
have
for
your own
being
timer
with
when
us
you come
today,
to this
Chairman
and set it on
Powell.
your desk.
Chair Powell, I just want to echo at the outset some of the
He's
concerns
tweeting.
that my
He's
colleagues
tweeting
have
right
raised
there.
about Vice Chair Michael Barr's, quote, holistic, unquote, holistic review, unquote, of capital markets, and also about the Fed engaging in climate policy, as well as your decision to put Vice Chair Barr in charge of the Community Reinvestment Act rulemaking. With that said, I'm going to dive right into my questions. Chair Powell, I was pleased to see that the U.S. Coin Task Force released their report on the state of coin a few months ago. The report notes that the Federal Reserve and U.S. Mint will be jointly contracting with a third-party consultant to review the coin supply chain and develop recommendations to improve it. Chairman Powell, could you provide us with an update on what the Fed has learned from its review of the coin circulation issues that occurred during the pandemic?
So
remember when there was not enough coins? It was really weird.
The natural flow of coins in the
so
economy
strange.
slowed down a lot because
it was like no
people were staying
quarters.
home and that kind of thing, and they may have switched to non-coin based means of payment. And we feel like that the evidence is that that's continued now. People are paying electronically and things like that, and coins are sitting in jars and on people's desks and at home, and they're not circulating back into the banks and thus to the
That makes
retail
sense. I
stores.
stopped using coins
And so
altogether.
we're
I
working
can't
on that.
remember the
We're
last
working with
time I
the
used a
Mint. We're
coin.
working with all the
I don't use
stakeholders
coins
in
anymore.
the
It's
coin
true.
ecosystem to try to address this problem, and we're well aware of it.
So it seems to me that what we learned from that is that it's probably necessary to have a greater reserve of coins if there is such an interruption in the future, so that commerce is not indeed interrupted. Would you share that broad view?
That sounds right. I'm not an expert. I will say it feels like we need more coins now because more of them are sitting in people's homes and pockets, and they're not flowing back to where retailers in particular need the flow of coins. So that sounds right to me.
On a related note, could you speak about the importance of maintaining cash as a viable payment option, particularly for those that lack or don't have access to traditional financial services?
We think it's absolutely critical because there are people who don't have credit cards. Many people don't have credit cards. They don't have good credit, and they need to be paying in cash. And when stores are not dealing with people who don't have cash, it's a serious problem for those people in the economy. We have it at the Board of Governors, and you see it elsewhere because most payments are now taken care of by credit cards, and it's very efficient. But we need to be looking out for people who use cash.
Thank you. I appreciate that perspective. Picking up on Mr. Lukemeier's concerns that he expressed earlier, as you know, the Consumer Financial Protection Bureau's funding mechanism is intricately linked to the
When's
Federal
the last
Reserve
time you used a
system.
coin or a quarter? Let me know.
According to Title 10
On
of
Twitter.
Dodd-Frank, each quarter the CFPB director requests an amount that is reasonably necessary to carry out the Bureau's authorities, and the Federal Reserve must transfer that amount so long as it does not exceed 12% of the Federal Reserve's total operating expenses. For the first 5 years of the existence of CFPB, of course, there was a relaxation there with respect to that 12% cap that allowed $200 million annually to be spent beyond that number so long as it was reported as long as the reported excess was sent to the President and congressional appropriators. Chair Powell, during your chairmanship, has the Fed ever rejected a CFPB budget request?
I do not believe so.
Hard out at 1 o'clock.
And could you tell us what policies and procedures
I have an interview
are in
anyway I
place
got to
at the
do.
Fed to ensure that there is no waste, fraud, or abuse, or that these limits are not otherwise exceeded?
So we have no role in engaging with that. It's really the what we share a common inspector general who does work on those issues, but we don't in any way. We don't have any governance of any kind over the CFPB. We're just a source to them.
Thank you. I appreciate that insight. In closing, Chair Powell, yesterday Senator Warren asked you what you would say to the 2 million people who may lose their jobs if the Fed keeps raising interest rates. Frankly, Senator Warren should be asking herself the same question when she voted and advocated for the Democrats' reckless spending packages that caused this inflation that we are seeing today, and is the reason the Fed has had to raise interest rates, in my view. Frankly, I would call on Senator Warren, the President, and the Democratic Party, for that matter, to apologize to the American people for causing this kitchen table crisis across the country. With that, Chairman, I yield back.
Now recognize the gentlewoman from Massachusetts, Ms. Presley, for 5 minutes.
Massachusetts,
Thank you,
baby.
Chairman Powell, for joining us today and for your testimony. I'm going to focus my comments and my questions on the high costs that families in my district are seeing because of your interest rate hikes. Now, while the Fed has acknowledged that higher interest rates are not the primary driver for the slowdown in price increases, you continue to raise interest rates, risking not only millions of jobs, but also
Do they not
a
realize
recession.
what it means to raise
Based
interest
on
rates?
projections from the Fed, approximately 2 million people will lose their jobs. So that's 2 million families who will struggle to put food on the table, keep a roof over their heads, and to make ends meet. But the economic hardship does not end there. Mr. Chair, I would like to request unanimous consent to submit a recent paper by the Federal Reserve Bank of Cleveland titled Post-COVID Inflation Dynamics into the record.
Without objection.
Chairman Powell, are you familiar with this publication, yes or no?
No, I'm not.
Okay. Well, let me give you some context. In this paper, the Fed's own economists predict that reaching the 2% inflation goal that you have set will be impossible without causing a recession and spiking the unemployment rate to 7.4%, which translates to millions of working people losing their jobs. Now, Chairman Powell, many economists agree with me when I say that engineering a recession to bring inflation under control is not the right strategy, especially at a time when we are seeing inflation cool in real time, independent of your rate hikes. So on behalf of the people of this country, to prevent a recession, yes or no, Chairman Powell, will you pause future interest rate hikes?
No, he can't say that.
We're not seeking to.
She's so pro
to have a
Bitcoin, but she
recession,
doesn't
and we
know.
don't think we need to have a recession to get
Respectfully,
price stability back.
will you pause interest rate hikes, yes or no?
I don't do yes or no on will I pause the interest rate hikes.
Oh,
That's a
in your
serious
face!
question.
In your face!
And I can't tell you because I don't know all the facts. That's not.
like,
My time. And in fact, it is a very serious question because it
He
has
was
a
just
very
like, I ain't
serious
gonna do it.
implications. The people who will bear the
I've
brunt
never
of
seen
an
him get so
economic
feisty in my life.
recession
He was like, don't
are
do
our
yes.
most vulnerable. We know
I
from
agree
past
with her.
experiences that recessions
She's
have
right.
catastrophic and deeply
horrible.
inequitable consequences. In fact, while some will catch a cold, others will catch pneumonia. But you know that. An economic cold or pneumonia. In fact, in your opening statement, you said, we will stay the course until the job is done.
Yeah, they don't care.
To
Exactly.
conclude, we understand that our
2%,
actions
they don't
affect
care.
communities,
It doesn't make sense either. I
families,
get
and
it. You're right. It's
businesses
all a mess.
across the country.
It's ridiculous.
Could you elaborate? What is this effect to communities, families, and businesses? These interest rate hikes.
Well, right now we're trying to bring down inflation on behalf of all those families. I think high inflation is hurting, particularly working families all around the country, very badly. And as you know, if you're on a very limited budget and you don't have a lot of excess earnings, When prices start going up, you're in trouble right away. People, middle and upper middle class people have more resources. So we think it's absolutely critical for the working people of this country that we get inflation back under control. And also, while we're at it, we have a dual mandate.
Apologies, Mr. Chair. I'm just reclaiming my time here. Here's the thing. The most devastating impacts will be to our most vulnerable. Veterans to our most vulnerable. Veterans, the elderly, low-income workers, black and brown workers, those who have often ignored and been neglected in the name of what you refer to as appropriate monetary policy. And yet, you assert that you will stay the course. It's unconscionable, and our most vulnerable workers and families cannot afford to wait for you to realize the harm that you were doing. In my opinion, this sounds more like the assertions of a greedy corporation than someone who has a public mission on behalf of the people of this country. One more question with my remaining time here. Chairman Powell, another consequence of your interest rate hikes has been the increase of the average 30-year fixed mortgage rate to 6.6%, double of what it was 2 years ago. Do you see this widening inequity in the housing market as a problem? And what steps will you take to make housing more affordable? This is putting home ownership further and further out of reach.
See that pump coming right there out of the fallen
constituents,
wedge?
New parents,
That's
millennials,
bullish
people of
divergence.
color, contributing to inequities and the racial wealth gap.
Just
What are
learn.
your thoughts on that?
Well, our policies do
Gentlemen,
affect.
Gentlelady's time's expired.
I am doing TA the whole time here.
Can submit for the record or answer.
He should be able to answer
I'll
the
briefly
question.
say that
It shouldn't be part of
again,
someone's
that,
time when he answers
interest
the
rate
question.
policies affect
Like, that's his time.
interest-sensitive spending very directly. When we cut rates, they help housing. When we raise rates, you see the effect on housing. So
Thank you.
The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us today. We currently have $32 trillion in debt. Our debt-to-GDP ratio is 120%, the highest it's ever been. And yes, we have a debt ceiling fight brewing for this summer. I would argue it's an opportunity to get our fiscal house in order. But sadly, there's no meaningful bipartisan effort to responsibly address our debt. Both sides have even preemptively started political attacks, alleging either side wants to cut Social Security and health care. But politics and talking points will not fix our problem. Our debt is the greatest national security threat. Social Security will be insolvent in 2033, and our healthcare system is fundamentally broken. We spend twice as much as the average country per person, and our obesity rate is 3 times the average. I want to be clear, though. I'm not advocating cuts to Social Security, but my Social Security will have to be different than my father's, and we must change the incentive structures of our healthcare system. Briefly, let's go over some history. Social Security was created in 1937. The retirement age then was 65, and average life expectancy was 60. Easy to see how that math works. In 1960, Congress raised the retirement age to 67. It has not been increased since then. That year, life expectancy was 69. That math still works due to a growing population, but it's getting narrower. I will throw in another few statistics for that year, 1960.
Interesting.
14% of Americans were obese, and our debt-to-GDP ratio was 53%. Let's fast forward to this year. Our retirement age is still 67, but our life expectancy is 77. That math clearly does not work, nor is the program functioning in the purpose for which it was designed. And shockingly, our obesity rate is 37%, and we spend $13,000 per person on health care compared to the global average of $6,000 per person and 13% obesity
I feel like
rate.
it's higher than 30.
Clearly, our healthcare system is failing. Our system focuses on managing sickness where we should be facilitating health and wellness. We will only meaningfully be able to address the debt ceiling by focusing on the biggest drivers of our debt. Responsible policymakers should be focused on saving Social Security by reforming it and transforming our healthcare system to facilitate a healthy citizenry capable of working and being contributing members of society. The American people deserve more than the political nonsense. 5 years ago, the number one issue I ran on was debt. It has been and continues to be our greatest national security risk. I hate to say it, but the last 4 years has gotten way worse. Congress has spent $7 trillion, of which $5 trillion was done mostly on party lines. The Democrat majority has not only spent money we don't have over the last 4 years, but their fiscal policy has caused out-of-control inflation, which caused you to raise interest rates. Last year, I asked you if you ever took into consideration the impact of interest rate increases on the cost of our debt service. You appropriately and adamantly said no. Our debt service cost the next 10 years will be over $10 trillion.
I don't know about
I'm going to point
Bitcoin.
out two things. Number one, that is more than all of our debt service since 1940 combined, the last 80 years. And while you did not take interest rate increases impact on our debt service into your decision making, the best estimate is that those rate increases will increase our debt service cost by $2 trillion in the next 10 years.
Of course.
So basically, the $7 trillion that we spent, Democrats spent in the last 4 years,
we're going to have to pay
is
more
going to
for.
cost us an additional $2 trillion.
Yes, exactly.
And that's not factoring
now
in
you're
future
getting
rate
it.
increases as you continue to appropriately try to get inflation under control.
That's the best thing I ever
As
heard.
You can tell this is a huge problem.
Definitely.
The $7 trillion in unnecessary spending in the last 4 years has caused inflation.
Of course.
Some of my colleagues across the aisle disagree with that causal relationship. Clinton's Treasury Secretary and Obama's Director of National Economic Council, Larry Summers, wrote an op-ed before they spent the money and said it was going to cause inflation. And he has gone on the I was right tour for the last couple years. We need responsible policymakers.
He said
to
it
address our
himself.
debt. Let's talk about what's not serious.
They don't like to talk
That's
about that.
minting a $1 trillion coin. Many of my colleagues across the aisle have advocated for this. Luckily, both President Biden and Secretary Yellen have said that this is not a serious proposal, and they have no plans of considering it. Unfortunately, the Biden administration has a bit of a history of doing a 180 when the political winds blow. Most recently, he said he would veto the D.C. crime bill, and now he's adamantly supporting it and plans to sign it. So, Chair Powell, my only question of you is if Biden and Yellen send you a $1 trillion coin, will you accept it?
What I will say to that is that this only winds up one way.
What does he mean?
And that is with Congress raising the debt ceiling.
So you will not accept a $1 trillion coin and treat it as $1 trillion if it's sent to you?
I'll add there are no rabbits to be pulled out of hats here. This only ends with Congress.
I know you don't like yes or no's, but if you are sent a $1 trillion coin and asked to treat it as $1 trillion, will you treat it as $1 trillion?
That would be a rabbit coming out of a hat.
I'll take that as a no. Thank you. Mr. Chairman, I yield back.
Who's getting
now
a $1 trillion
recognize the
coin?
gentlewoman from Michigan, Ms. Talib, for 5 minutes.
Thank you so much, Mr. Chairman. Thank you, Chair Powell, for being here.
Chair Powell.
You have a lot of economic, projections, economic projections, various data, various reports that are coming out. How much, and you've studied inflation, right?
It's a lot of lipstick.
Your number one priority right now.
But she's a sweetheart.
How much is
She's a sweetheart.
inflation impacted
She has a nice
by
smile.
these three things?
Sweetheart.
Corporate profiteering, egregious executive pay,
I like to find something nice about everybody,
and the
No
use
matter
of
what.
stock buybacks.
So I don't have numbers, but I would say in the case of executive pay and in the case of share repurchases, I can't think of how it would affect inflation. In the case of executive pay, that would be very small in terms of the broader economy. In terms of
You
profits,
keep your mouth
though,
shut up there, little cutie.
the way I think about that is profits are high. The places where profits are really high is places where there are shortages and supply chain issues. And as those things get better, as they are, you're going to see inflation come down and even prices come down, and you'll see corporate margins come down there. And that'll be part of how inflation comes down.
So does that corporate profiteering does impact inflation? You don't have any stats of percentage-wise how much of it?
We'll get to the bottom of that
because
after this.
I really paid attention to your testimony in the Senate hearing yesterday, and there was a lot of conversation about, my neighbors and residents' wages and so forth. They're finally starting to see a little bit more closer to possibly getting fair wages. It's not even far enough. But I don't know if the Feds is paying closer attention to monopolies, corporate profiteering, and executive egregious pay. All of it, even the stock buybacks, you're saying all of that aside, you're focused more on wages and increasing the interest rate than on those other
Our focus is really on price stability, not so much wages. Wages play into that because they're an important cost for business, but they're not. We're not trying to achieve a particular level of wages. We're trying to achieve 2% inflation.
Yeah, and I think it's really important, Chairman, what we saw during the pandemic
Sherman.
is, the wealthy and the corporations continued to profit in large scale and still do buybacks and still do really egregious executive pay and benefits and so forth for those at the top. And then, of course, the communities and such were impacted by it. But what I hear consistently is folks thinking that's the reason. All of a sudden wages are skyrocketing, all this. But all I see is continuation, again, of those that are already getting a huge benefit, the folks at the top, the executives and so forth. My friend Glenn taught me this today, that the feds are actually sitting on, something in Dodd-Frank Section 956. You all are sitting on the last 12 years on guidance regarding executive compensation and the high risks of it. Like around, there was some sort of proposal done, not implemented. Again, it's been 12 years. Why is that something that you're not concerned about regarding inflation?
Well,
like you guys are sitting, one, you're sitting on it, right? Why?
Well,
it's been 12 years. And then two, why is that you're saying that's not big deal? That's not going to impact the cost of products and so forth for our residents.
It's a multi-agency rule, and there have been repeated attempts to get 5 or 6 or 7, however many it is, agencies.
You didn't just say that, RJ. You're ridiculous.
That's one thing.
On disclosures?
Oh my gosh.
No, this is on. It's on policies to.
Which include disclosures and arrangements regarding executive pay and the risk of it.
There, anyway. 956 is. You're right. We haven't been able to get agreement among the agencies, but more to the point, there. Boards long since, this is just for the big banks where we have this authority, long since board of directors are very focused on how executive compensation works and that it not reward, unnecessarily risky behavior and that kinds of things.
Yeah, but in Dodd-Frank, which Congress passed, there should, you're supposed to put something in place, and it's not in place. And look, I'm saying this because so many people in this chamber, and I feel like the feds are more obsessed with wages than they are in regards to the monopolies, the corporate profiteering. There hasn't been any, really, I don't think there is a laser focus on that, and it's really, because I think the feds and Congress can support fair wages and still combat inflation if you are fair in combating egregious executive pay, monopolies, and corporate profiteering.
Yeah, but that's how America was made.
We don't do competition policy, and we also don't, broadly speaking, regulate corporate wages.
But
956 would have addressed it. 956 addresses it. You should have it's 12 years.
The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank you, Mr. Powell. Appreciate you coming
business
in.
America. Sad to say.
I don't have to tell you the fact that housing, so goes housing, so goes the economy. I'm from a state that, from South Carolina, we have people moving in, the population's increasing. And I can tell you housing, not just single-family housing, is in trouble. People are finishing what's in the pipeline. It's now affected multifamily apartments, the high rents that they did get with inflation. That's kind of entirely caused, for the most part, by the policies of this administration with gas, buying it from other countries, with supply chain shortages. There's no reason to start a project when you can't get supplies. And that's what we're facing in the housing industry at all levels. So any increase in interest is just another dagger that's going to kill the housing industry, along with commercial projects that, again, the pipeline's filling up, but the pipeline, once it leaves, you're not going to have any. And I'm from a state that's with people moving in. One of the things that you hear, I think Mr. Davison mentioned, was regulations. Banks are complaining about being overregulated and the costs associated with it. CRA, I know when Brainerd left, it's in a state of flux. Who's determining that, and when will you have some guidelines out?
That'll be done by the whole Board of Governors when we vote on it, and also by the OCC and the FDIC.
Will they have any input from those who are having to pay the price of implementing CRA, like get any input from banks that are having to navigate?
So I know that throughout the multi-year process, there's been a tremendous amount of interaction with banks, tremendous amount, and bank lobby groups and also consumer groups, and then. But yeah, there's been a ton of input, and working with the industry to try to achieve these statutory goals efficiently. I won't say it's perfect, but there's certainly been a lot of interaction.
So they're getting input prior to implementing the requirements for CRA or the guidelines for CRA.
Yes, I think I'm pretty sure there's been quite a bit of interaction with the industry in terms of what what to do and how to do it.
Okay. Now, I think you've stated that you don't feel it's the Federal Reserve's policy to get into implementing climate change.
We're not, and we shouldn't be climate policymakers. We do have a small role, focused role to play, principally with the larger banks, to make sure they understand and can manage their climate risks in the long run.
Should it be mandated?
It's weird. So he says no, and then
climate change.
He's been going back and forth on this the whole day. Like,
I think again, climate change is something that's going to affect businesses and people and regions and states and whole countries, and I think that's got to be a job for
the climate's always changing, right?
Large. I think what we're going to affect.
You can say climate change
any
time in the year.
Manage the risks.
Climate just changed
that they're running, and these are principally longer term risks.
What's concerning to those of us in the business community who have to borrow for banks? The Federal Reserve is conducting a pilot climate scenario analysis that's being mandated, not asked. It's being mandated for the six largest banks to participate in. That seems to me like a pretty good, when you have to do a scenario and mandate that they do this, is that not the Federal Reserve getting directly involved in mandating?
I think the banks actually want this. They want these six big banks, they have to face this globally, and what they want is uniform approaches and guidance on how to have one set of rules. They're already running, the big six banks that we're talking to, they're already running climate scenarios all the time, multiple climate scenarios.
Most of the banks are well capitalized now. That could change. And this is just another expense that is out there. On the CFPB, the history, I think you said it was 12%. It cannot go above 12% ratio. That does not seem logical to me. Has it ever been below the 12% from your perspective?
That's someone here quoted the law, and that rang a bell for me. So that is what the law says. Have they been below? I'd have to go back. I'm happy to provide. It's all.
If you could, because it seems to me like that's if you've got that cap, businesses couldn't operate like that. Because it would be no incentive to reduce the price as long as it's automated.
That's the way the law is set up.
Right. Thank you for being here.
Thank you.
The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being with us today. The end is in sight. I would like to begin by highlighting an issue that has been a concern for the Congressional Hispanic Caucus and others. I know that the chairman has suggested that we're going to weave in the diversity and inclusion issues throughout our hearings. So here goes my concern. There has never been a Latino Federal Reserve president. And further, only about 5% of the Federal Reserve's overall workforce identifies as Hispanic or Latino. As we know, over the past year or so, there have been several presidential vacancies at the Federal Reserve banks, and there has still been consistent failure to appoint a Latino candidate. Chair Powell, are you aware of this trend, and do you agree that it's a problem that our diversity and inclusion numbers are in the Federal Reserve Board are not reflective of the Latino population?
Yes, it's something we've been focusing on.
All right, and can we get a commitment from you that you'll work on the workforce issues internally?
Yes.
Well, thank you so much. And I'd like to now follow up a little bit on some of the questions from Representative Norman, because I too have a concern about housing costs, particularly as it relates to equity and the negative impact on minority communities. I think you said in your paper that activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. As he mentioned, the rates are higher, not only impacting single-family housing, but multifamily housing, and it's also becoming even more and more difficult for people in my district, which is 77% Latino, to be able to buy their first home buyer, the workforce, entry-level kind of housing. As financing homes get harder, as mortgage to find and mortgage rates rise, the population of home buyers is skewing towards older, wealthier, and whiter communities. In many cases, in our suburbs, equity firms are buying out the housing stock. Chair Powell, can you please speak about the relationship between Federal Reserve interest rate hikes and housing inequity, and what needs to change here?
Well, what needs to change is we need to get inflation under control so that interest rates can come back down. In the meantime, they're high because inflation is hurting all of your constituents, not just the housing sector, and all of everybody's constituents. And it's our job under the law to restore price stability and also to keep maximum employment.
You're not going to be able to.
Is there
I've been
anything else that
saying
Congress
this
can be
all
doing in this
along.
respect?
This is going to turn bad, I'm telling you right now.
That would be up to Congress,
It's
but
going to be a
there
mess.
are lots of ways in which Congress can support.
They're never going to get that inflation rate to 2%. They're going to end up changing that. I'm predicting they will change that 2.5. They will eventually have to change that.
Again, in your remarks at page 2, you mentioned that, of course, we all know there's been a record historic unemployment rate. It's down now to 3.4%, the lowest, I believe, in history, and thank you, Mr. President, for that. But you also mentioned that there's 1.9 job openings for each unemployed individual. I wondered if you could tell me how you define unemployed individual. What does the unemployed individual profile look like?
So that has a very specific meaning. It's someone who is not working but is actively seeking a job. So, for example, if you take 6 months off and stop looking for a job, you're no longer unemployed. So that means there's a group of people who are kind of around the edges of the labor force who don't count as unemployed, and those people are marginally attached to the labor force, that kind of thing. But to be actually unemployed, you've got to be looking actively for work in the statistics.
Right, so it does not include people who are perhaps disabled and cannot find accommodations in the workplace to be able to get a job.
Unless they're looking for it. The test is whether you're actively looking, I think, in the last 4
Actively looking regardless of, age,
That's right.
whether or not they're...
It's not a value judgment. It's the way we assess unemployment. We look at the other groups, too, but actual unemployment is...
How do you factor in the people that actually are on unemployment insurance?
Sorry?
How do you factor in the people who are on unemployment insurance?
Well, they're unemployed. They've got to be, by definition, we count them as unemployed, or they wouldn't qualify under the state requirements.
All right. Well, I just want to make sure that we clearly understand that there's children, there's people that are older, people that are disabled, people that can't find daycare. There's so many other reasons why someone is unemployed.
Yes.
All right. Thank you. I yield back.
Gentleman from Wisconsin, Mr. Stile, the chair of the House Administration Committee, is recognized for 5 minutes.
Chairman Powell, thank you for being here with us today. Your testimony today has been insightful as we look to tackle inflation, the impact that it's having on families across the United States right now. I want to go back to a comment that was quoted to you as regards to a question from Senator Kennedy yesterday regarding the impact that fiscal policy is having as it relates to inflation. And the quote that was attributed to you was that it wasn't a big factor. As we look at kind of a whole host of policies here on Capitol Hill, from reckless spending that we saw in the previous Congress, a lack of what we just discussed, individuals who are outside the labor market, how do we get these folks back into the labor market, whether or not we have policies that are discouraging folks to come back into work, as we look at high energy costs and opportunity to drive energy prices lower by unleashing American energy. How do you factor in the fiscal policies, or how should policymakers factor in the fiscal policies and their impact that's also having on inflation? Not looking for your advice on the fiscal policies, because I know you want to stay out of that, but how should lawmakers be looking at the fiscal policy and its impact on inflation?
So let's take energy, for example. So remember, inflation is the change in prices. It's not the level, as you well know. So energy prices have been coming down. Right, they're still high, but they've been coming down, and they're contributing negatively to headline inflation. So when I say it's not contributing to inflation,
holding that trend line,
that's what I mean. In addition, if you look at aggregate spending, it peaked, and then it's been coming down. So the fiscal impulse is actually negative at this point. It's no longer most of the inflation that we now have, something like 2/3 of the contribution of inflation in core PCE inflation comes from the services sector. And that isn't really about fiscal policy. Fiscal policy was important at the very beginning, so was monetary policy, by the way, but now it's more about just inflation is out there, and you have to bring it down. The record is it doesn't come down by itself unless it's driven by, transitory factors. For example, in the goods sector, the supply chains have been getting better, and as that's happened, goods inflation has come way down, and sometimes it's negative now. I hope that's helpful.
Yeah, no, thank you. And so to take that one step further, we're waiting on the president's budget. It's over a month late, but we're anticipating receiving that in the near term. And as we look at interest payments on the debt and the cash flow implications that has, not asking for what you're going to do at the next board meeting for obvious reasons, but as you are in those deliberations to future board meetings and potential rate increases, how does the impact of interest on the debt factor into the calculus of you and your colleagues?
So we don't look at that. We're not, if we started to change our monetary policy because we were concerned about the level of debt payments and things like that, that's not something that the United States needs to do, and it's not something we do.
Why would it be something the United States doesn't need to do? Could you elaborate on that?
Yeah, we're going to do our job. Congress has given us the job: maximum employment, price stability, regulate the banks, manage the payment system to some extent. We'll do those jobs. We don't have to worry about the United States budget. That is not our job. And it isn't that the debt today is unsustainable. It's that the path is unsustainable. So we can service our debts. It's just that we're on an unsustainable path, meaning that the debt is growing faster than the economy. So we would never consider. We will never look, if a central bank has to avoid taking actions because it's concerned about the budget, that's called fiscal dominance, and that's a thing you don't see among advanced economies, and it would be something we think we're a long way from that.
Thanks for your feedback on that point. The CBO just released their report showing potential
a lot of nice
payments
ties.
on the debt,
a lot of nice ties,
accelerating dramatically over the next decade.
Got some good ties.
Showing it would be 14% of our fiscal spend. To compare that, right, national defense would be 13, Social Security is also 14, so it's in that level. That's a policymaker issue, but your insights are helpful. I know I only have a few seconds left, and a handful of my colleagues have commented
One, two,
on the
three, that's a few, you're gone.
review of bank capital standards. I just want to echo
a few people,
those concerns
3 people, 4 people. I don't know if it's 4 people. That's a quad. You got a couple, you got a few, you got a quad.
Could you just comment briefly about how you quantify the cost of higher capital in the supposed benefits, and,
a few
and
seconds.
how you balance
more than
that risk?
Yeah, almost
reward.
a minute and a half over here.
It's always a balance.
80
exactly
seconds.
As you say. We know that the capital increases that I supported back in 12, 13, 14, 15, 16. Earlier
Bitcoin
in my
is
time at the
flat
Fed,
today, huh?
They made the
Sideways.
banks stronger, and they made them more resilient.
Wow.
And you really want
resistance
that. You want a banking system that can
22,200.
stand up and keep doing its job in times of crisis. So, but the exact balance between that and the availability of capital and the cost of capital is always going to be a matter of judgment.
Thank you very much. I yield back.
The gentlewoman from Georgia, Ms. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman.
Wait, that
As
was
the
a
member
funny
of
look.
Congress
You saw that
representing
look?
Atlanta, the city with the highest racial wealth gap in the country.
Saw that look?
Capital and the cost of capital is always going to be a matter of judgment.
Thank you very much. I yield back.
I want to get to that.
And the cost of capital is always going to be a matter of judgment.
Thank you very much. I yield back.
There it is. Yo, I got to get that. I caught that out of nowhere. His little Pinocchio head. What is he doing there? This is funny, man. Sorry. I don't mean to disrespect the other lady in Georgia.
So it informs our pursuit of maximum employment. We're trying to take a broader and more inclusive understanding.
She's basically asking
of what
about
that
unemployment in
statutory
Georgia and the idea of life.
means.
You can only assume
Thank
hardworking
you.
people.
2 weeks ago, the Federal Trade Commission released data indicating that Georgians reported the most fraud and scam claims of any other state in 2022, amounting to millions of stolen money. The Federal Reserve's website has resources to help consumers protect themselves from scams where criminals leverage the Federal Reserve's name, including emails claiming potential victims are eligible for lottery winnings, robocalls threatening arrest in exchange for money, and other phishing communications. Chairman Powell, how does the Federal Reserve measure whether its counter-fraud communications are reaching the most vulnerable households and communities, especially those that might not be following the Federal Reserve press releases or your website, or have limited access to broadband?
So we do, when those kind of scams happen, particularly when they involve us, we go on social media to try to reach people and tell them that if they're contacted by someone pretending to be a Federal Reserve person, that's not So we do that. We work with our Inspector General who works with law enforcement to make sure that law enforcement's involved. So we're aware of these scams. I think you're talking about the ones that involve people pretending to be a Federal Reserve person and get in touch with me and we'll send you some money. And so we do what we can to reach out to the public on that.
So is that after the fact, but what happens before so that the general public is aware that this is happening? For those people who are not on social media or tracking is there another way to get this information out to the general public?
We do what we can. We're not an institution that deals with the general public very much. We deal with banks and of course our rate hikes and rate cuts, our monetary policy affects all Americans. But I think when something like that happens,
I love Elsa.
It's a broad program. It's a bunch of people who are perpetuating a fraud on many, many people, and we try to get out there quickly and try to reach people.
This was an easy one for him. He's like, I could talk about this all day long.
Thank you, Chairman. And Chairman McHenry, I yield back the balance of my time.
She must be a new person. Just wanted to.
That is very kind and gracious of you. The first of the day. We need to commend that for the record.
Wow.
With that, we'll recognize the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
The Muser.
Thank you very much, Chairman McHenry. Thank you, Chairman Powell, for being with us. Chairman, is the Fed's commitment regarding ESG not to force investment banks to renege on their fiduciary responsibilities?
We don't actually have policies in effect in that space. That's not an assignment that we have.
You saw some issuances by heads of some investment banks, not to mention any names, that felt that was the case.
This guy reminds me of
the Fed was asking them to.
SEC, Fed. You stated a couple of minutes ago that you feel that some sort of ESG. You stated that banks want it, and
I'm talking. No, that's different, completely different. It's regulated financial institutions that we regulate and supervise. They're subject to, particularly the big ones, are subject
to
the
Fed,
climate change.
You agree that
climate
the Fed
change
won't,
issues all over the country.
Won't ask banks to renege on their fiduciary responsibilities. The Fed won't do that.
We don't regulate the investment banks. The SEC does.
Okay. So the answer is no.
What's the question again?
I'll move on. Earlier, some of my colleagues and Chairman McHenry questioned the holistic review of the capital.
You got to at least tell the guy the question again.
This holistic review, which no one has seen, according to my sources, but there are published reports that it will call for more capital to be held by banks. I understand the deferral to Vice Chair Barr, but do you have any thing that you could add that would warrant a need for large banks' capital increase?
So there isn't a proposal to evaluate or talk about yet. Vice Chair Barr has indicated he was going to take a look. He said he thinks capital is strong, and the question really is it strong enough? And I know he's been working, and there'll be a process when he does arrive at conclusions. He has no authority to enact something himself. It has to go through the Board of Governors, also through the FDIC and the OCC.
Okay, this has nothing to do with the QT.
Process.
I'm sorry, with the QT initiative, the tightening of the money supply. They're not related at all?
No, I would say not.
Are you comfortable with the QT reductions which have taken place?
Yes, the balance sheet is, we have the balance sheet moving down at a healthy clip, and it seems to be going pretty well.
Quantitative tightening, QT, quantitative tightening. If you don't know what QT was, quantitative tightening.
Spending.
Government
as you well know,
selling
very
stocks, or basically selling stocks on you.
Meanwhile, energy costs for the average American have, from heating oils to gasoline, have increased by over 40%, and businesses, of course, in just over the last 2 years. So high energy obviously affects the cost for manufacturing, wages, general cost of living in almost every aspect of society. Would not such fiscal and energy policy work of the Biden administration working hand in hand with initiatives such as QT and initiatives of the Fed be far more effective than the Fed fighting inflation on your own?
Well, I mean, we are the agency that has the responsibility to restore price stability, and we just have to do it. That's the task we've been given under the law. It's great if Congress helps. It's great if the administration helps, but we have to deliver it, and we will. That's our responsibility, which we fully accept.
We're not risking stagflation if the fiscal policy and monetary policy are working against each other?
Again, we don't comment on fiscal policy. That's for elected people, and we have a job, maximum employment and price stability. We use our tools. We try to stay in our lane, stick to our knitting.
It's just the fear of a number of people that we're going to have high interest rates and higher than 2% inflation if there's not that level of fiscal and monetary cooperation.
Again, fiscal policy does what it's going to do. We take that as exogenous. That's the fiscal policy will be what you and your colleagues do with, and that comes into the economy, and we see it, and we don't have a view. We don't try to comment on the decisions that you make, and we use our tools to restore price stability no matter
Heavy
what.
resistance 22,266.
Outside of our building.
If you can't get back above there, expect more downside.
Mr. Chairman, I'll yield back. Thank you.
Gentleman yields back. We now recognize the ranking member of the Oversight Subcommittee, Mr. Green of Texas, for 5 minutes.
Thank you, Mr.
This
Chairman.
has to be done.
Thank you, Mr. Powell, for being with us today. I greatly appreciate your work. But I would like to take just a few moments to talk about how our legislative bodies have legitimized systemic racism. It's been done by having a Fed that has a responsibility to produce maximum employment, knowing that the 2-to-1 black-white wage gap exists.
I'm going to fall asleep.
Traditionally. And also knowing that traditional actions and methodologies will not change that. But yet, we won't give you the authority to make recommendations or to take actions that would directly target that. It's not your fault. It's the legislative body's fault. We perpetuate systemic racism in your mandate of maximum employment. We also perpetuate it in lending because we know.
Why is his ear so big?
That
his ear
invidious
is
discrimination
huge
exists
compared
in
to his ear. Wow.
We know it exists. And there are laws that will prevent and punish persons who cheat banks. You will be prosecuted and you will be fined criminally if you cheat a bank. No such law exists if you cheat a customer. And we know that black people who are more qualified than whites will get less money when they get a loan and pay a higher interest rate. These are all things that are the case. They're true. So legislative bodies continue to legitimize systemic racism. And the bodies have become so bold now, so many of the members, they're so bold now as to say they're sick and tired of hearing about this. They don't want a discussion about racism and system.
I'm going to call it there. I think we did great. I'm not trying to disrespect him and what he's saying. I just want to try to slap in a Bitcoin update for everybody watching here, and I got about 4 minutes to do so. And I got to do my job. My job is to go over Bitcoin every single day and not to sit here and listen to people on the news. It was awesome the last 2 days. It's been fun. I love it. But let's get down to brass tacks. Let's talk about what's happening for BTC. Let me delete everything. Let's look at a fresh board and take a look at it here. We have resistance up at 23,009. We got resistance up here at about 22,500. We got a support zone that we've made at 21.4, and we have a support zone that we're hitting now at 21,000, about 900. We've tapped on the 21.8. Now it looks like, 21,891 on the lows in the last few hours, 8 hours. So Bitcoin, initially we found that we were in this wedge, but the wedge broke the wedge broke. We were in this little flag here. This ended up breaking to the downside. We shorted that. The short is still in the money right now. Chance that it continues to the downside. So, hey, some people are taking profits on the short, depending on who you are. I'm not a financial advisor. Nothing I say and do should be taken as financial advice. Whatever you want to do on that short, you can do. Here it is here. This is kind of our trend line that we've been toying with. We didn't almost make it back up to the trend line, which is a bit strange. Did we break out of it and break back inside? I don't know. Hard to kind of align ourselves perfectly with that trend line on all counts, which is strange. Usually you get that. Could we go here and say, I guess we had broken out, we'd settled the line and broke back inside? That makes more sense to me and gives me more like a nicer feeling. You can break the rules once you know the rules. That's something I would never have done until I've been trading for a long, long time. So we came back to the top, back to the bottom. We're in this little area here. Do we respect this zone? That's what it is. Can the 1 hour make a move? Let's look at our bigger time frames, like our daily and our 4 hour, and just assess what we're seeing on the bigger time frame. So right now you're oversold on the stochastic. You're not up at the top. I've seen big dumps come from here, though. Just because you're low doesn't mean you can't see a momentumous move, but we'll see from there. Right now, we're still hugging, basically. Look, swing up to swing up, technically, swing down. We're still hanging out with a hidden bullish divergence, and we're still on a higher low. Until the daily closes a low below 21,600, we technically still have a higher low. So some hidden bullish divergence on the daily time frame right there, right now, still somewhat confirmed. The daily in this falling wedge, like everyone can see, right, clear as day. 68% chance that the falling wedge breaks to the upside. Measured move is the length of the pole. That would take us past that high into 26,260. Can we get that move is the question. Let's take a look at our 4 hour. If you saw bullish divergence in the 4 hour and you were oversold, there would be a good chance. I mean, the RSI is super low. I deleted it. Let me bring it back in. I have a minute left. The RSI is super low, okay? But you can see that this is kind of pushing up here. That's pushing down. You have bullish divergence there on the RSI and on price action, which tells me that should be our bottom. It looks a lot like this divergence here that occurred, and we got to pump up. Look, this one looks very similar, and these both occurred at the similar areas. So do we get the pump off the bullish divergence? I'd be apt to long that, based long at blind, forget about everything else, and just long the bullish divergence. Many times in my life it's played out. Again, you have to just commit to it and go for it. Stop loss maybe below the previous bullish divergence and see if you can get to the top. So that's an idea right there, right? Someone could do, right? This is an idea. Again, I'm not a financial advisor, just an idea that I'm looking at. Possibly to long Bitcoin on the bullish divergence. Use these areas of support and resistance. Possibly we bounce off that area, right? You could even go all the way. You still got a 3-2. You risk 5.6 to gain 19%. So you're still a 3-to-1 risk-reward ratio, and you don't risk a lot. So that's an idea there that could play out. We looked at that before. We got stopped out on the massive dump. We switched to a short. We traded the short. So the idea is this. You could keep the short open this long. If the short starts to continue down, right, you can cancel the long before when you're at 2.5%, depending. Again, you do whatever makes you happy. I'm just looking at things in an open-minded idea. So this is the potential long. You got a oversold daily. Even the 2 hour and the 3 and the 3 day, even the 2 day and the 3 day are starting to get very oversold. Don't really worry about the price action, but the oversold stochastic. So it's all about this 1 hour. This is the kind of problematic price action that we're looking at here. And so when I crunch it in after I get off the 30-second all day, we see that we're making some type of bear flag here and consolidating tighter. The 1 hour is overbought and wants to come back down. So it tells me that it's likely to drop to the downside when the stochastics come on down. We take a look at our 15-minute. They're oversold too and could expect a bit of a bounce, though, and go sideways. That's a little bit of hope. And the 7-minute may just get a short squeeze. So watch the 7-minute for a possible short squeeze, as we know that can happen, especially with the meeting over and volume, may kind of come back and people are kind of done in awe. Even us, like we're usually trading. We were sitting there just watching. So a lot of people are doing what you're doing. You're not that unique. What were we doing just now? We were sitting and watching. So most of the market was sitting there just kind of listening to comments and hearing what people had to say. Can the 7-minute break us out of this triangle? And then eventually would have to go after this local point of control and get above 23,300. Highly unlikely, but it could happen based on how oversold it is. I want to see this 1 hour eventually reset, even halfway somewhere, and let the 4 hour take over. There's a chance that that divergence does play out and we pump. But we got to see the smaller time frames play out right now. And right now you have a resistance on the 1 hour at 22,270. And you got to break that to remain bullish. And that's where I end today on Bitcoin. I'll be going over altcoins in the trading group and talking about things as the dust settles. We see where Bitcoin kind of falls out today, and we will go from there. Everybody, thank you so much for being here. Please comment, like, and subscribe. Hit the bell for notifications. You can find out when I post my next video. Remember, if you came to the channel, then you're already doing the right thing.